Well, good evening, everyone. Welcome back to the channel. Let me get some things going here, and then we will have a live show. First off, let me do this. Show. Okay. So, when we go live, as we know, what do we say?
We'll do it live. Okay. We'll do it live!
And you know the rest. Okay, so let's get right into it. So we will have a free-form discussion this evening. We will discuss Yieldmax, growth investing. I'm live in the Discord. Anybody can feel free to hop on and chat with me. And we will definitely have a good time for sure. Didn't expect to be on tonight, but I'm here nonetheless. Okay, so we got a few commenters on. Welcome, everyone. And it looks like we have finally had someone enter the Discord arena.
How you doing, Coach?
Hey, Blake, how's it going?
Oh, pretty good tonight.
Oh, good, good.
I'm actually staying up a little bit late tonight, so I figured I'd join you for a chat.
Oh, cool. Yeah, I've been away all day, but I was like, oh, I got back. I'm like, let me do a live show.
Right, might as well.
Yeah. So
I noticed you titled it Yieldmax versus Growth.
Yes.
Yeah, I'm a big fan of both. Mostly I'm a fan of growth right now, but I will start hunting dividends and distributions here as I approach retirement.
Yep. Yeah, I want to talk about growth because Paul Varden's been giving me some tickers to look at, and I mean, most of my other stuff is growth, like my 401ks and whatnot.
Yeah.
Yep.
Well, and like you've said many times, you know, you can get cash flow from growth. You just have to be willing to sell shares as it slowly, grows in value and all that. Yeah.
Exactly. Like Nvidia, 250% over the past year. NVDY, still 120% is awesome, but you missed out on half of the return with it. So not bashing it. I mean, 120% is great, but total return, there can be more to be had.
Yeah, there is some advantage to like getting into Yieldmax because then it's sort of like you let other people do the options trading for you.
Yep.
You know, and your total return might not be as attractive as if you'd have just held the underlying, but at least it's sort of like a set it and forget it sort of thing. You know, some of them have had significantly better performance than others, you know, and that's one of the reasons I think I'm the most attracted to the equal weight index that they set up where they hold like 5% of each of their other funds.
Yep. Yeah, I mean, I've gotten a lot of questions about like YMAX and YMAG and stuff like that. YMAX is up like 8% for the year so far.
Yeah. Well, of all the things Yieldmax offers, I think YMAX is potentially the most attractive, just because, you know, at any given time, one or two of them are not going to do very well, and one or two of them are going to do really well, and so the net result should be fairly stable.
Yep. Yeah, and a lot of people like Ulti too, but I know they can balance out of like half of their positions at any given time.
Yeah, Ulti has the potential to be really good, but I think they need a value investor to help them pick what stocks to play.
Yeah. Yeah, I would agree.
You know, like they need to hire me.
Yeah.
Or just someone with value investing experience, so they choose undervalued companies that are probably going to go up in the near future instead of just chasing high implied volatility. I
expect with all the fund managers we've been talking to, someone's going to like hit one of them up for a job or something. Yeah.
Right.
Actually, I think Dissector said earlier he wanted Simplify to consider him for a job.
Yeah?
Yeah. I was really impressed, by the way. So a fund manager that I was in contact with watched in very great detail one of my videos where I was talking about their fee on the Maxi fund. It's like
the one that shows up at 11%.
Yeah, and they actually explained it. It was funny the way they worded it. They said, you had touched on our Maxi ETF and noted the seemingly absurdly high fee. We get questions on this a lot because the 10.33% coming from other expenses is a bit misleading. The reason the other expenses bucket is so high is we have historically used repurchase agreements, which the SEC requires we report the interest expense for, and other expenses. The flip side is, which is not captured in the fee bucket, is that the repos are collateralized by treasury bills, which are generating income that largely offsets the repo interest fee. The management fee is a much more typical 0.85%.
So they're using T-bills to offset most of that 10% or whatever, the 10.23%.
Yeah, yeah. It's I haven't ever heard of that, but yeah, that's interesting for sure.
Yeah, it's definitely new to me, but I've spent a bunch of time researching individual companies, not so much ETFs. So it seems like the more I dive into ETFs, the more I find interesting situations and unique characteristics that all the different ones have.
Hmm. Oh, Norm Bolito hopped in for a second, then he left.
Yeah, I think maybe he didn't realize it was a live stream or something.
Oh, I see.
He probably just wanted to hop in and chat with you like off air.
Yeah, yeah. Let's see some of the comments here. So, someone said, Yieldmax is killing me. I'm thinking about going to the wheel instead. Oh, the
The
dividend.
wheel is really attractive. I used to run the wheel. I quit running the wheel last year sometime, mostly because I refuse to sell covered calls on high tide, and all of my extra cash has gone into high tide for a little while now.
Hmm. Yeah, the wheel option strategy. I know there's a dividend wheel strategy as well.
There is
Yeah.
where you can collect dividends and or distributions,
Hmm.
and then add to that the premium that you collect off of running the wheel. You can also run. I was talking to Sam in another Discord,
Hmm.
and he's been doing this for a few months now, and he finally found out that what he's been doing has a name. It's called a covered strangle.
Oh, yeah. Is Sam the guy that goes by Grow Your Food or something? Is that him?
Yeah, he changes his Discord name every couple of weeks. But if
Okay.
you click on the actual account, you will see that it is Sam. It
Yeah,
is the same guy.
he's in here too. Yep.
Yeah. So he is similar to how I'm a permanent high tide bull.
Hmm.
He's a permanent Tesla bull.
Yeah.
And so he owns a rather large amount of shares of Tesla, and he's selling covered calls against, I think, about half of his position. And then he also has a margin account, and he's approved for the ability to sell cash secured puts using margin.
Oh, yeah.
But
Yeah, he posted his trades in here, actually.
yeah. It's a pretty interesting strategy. It's sort of like running both halves of the wheel at the same time, where you're both selling covered calls, doing like a buy right,
Hmm.
and then you're also selling cash secured puts at the same time. And he's doing this because he's super bullish on the ticker,
Yeah.
and he wouldn't mind getting handed even more shares. So it's a pretty wise attitude to a pretty wise strategy if you're super high conviction
Yeah.
and you really believe in the future of a company.
I actually met a financial advisor recently, and I had to explain to them what the wheel strategy was.
Yeah, a shockingly large number of financial advisors are not super financially literate.
You're right.
They sort of all get funneled into, you should be index fund investing, you should be doing the John Bogle approach. You should just buy the entire haystack instead of hunting for the needles in the haystack.
Hmm.
A lot of them are also trained to be extremely risk averse. Like
Yeah.
yeah, and often that's to the detriment of total returns.
This advisor was the same way. He's actually said he's expecting a major like black swan event this year, and he's putting his
Okay.
clients into conservative stuff.
Yeah.
Yeah.
Well, one of the things you can do if you're worried about a black swan is you can diversify into a variety of assets that you think might not drop.
Hmm.
So, that means buying some real estate, that means buying some bonds, that means buying a variety of companies, and some you can do that by buying an index, but the idea is that if the stock market crashes really hard, you can sell your investment property and buy more shares.
Yeah.
Or sell your bonds and buy more shares. And it's always good to have some sort of a plan for what would you do during the next black swan.
Hmm.
Could come next month, could come next year, could be a decade from now. It's typically unwise to insist it's going to happen soon, because a lot of money has been lost in opportunity cost from people that were super bearish, and their plan was just to hold large amounts of cash and get their wealth wrecked by inflation while they wait.
Right.
And they're missing out on that growth opportunity. So it's sort of a double-edged sword when you're convinced a black swan is approaching.
Hmm. Yeah, so talking about the wheel strategy, just to remind the new Discord members, so we have people in the wheel strategy subthread posting their trades every week, and they're really kicking butt. Like what I'm showing here, this guy's made 4,000 in the past week on these trades. Now I tried
trading. Is that trading from a ladder?
It is, yeah. I did try one of these trades on Clean Spark. very similar to what he did, and I rolled it because I didn't actually want to own the stock. And I know what they say. They say if you don't actually want to own the stock, then you shouldn't, sell the
Yes.
puts on it. Yeah.
Yeah, I say that a lot, and I'm not the only one.
Yeah.
You should stick to underlyings where you actually want to own it.
Yeah. So he got assigned at 1750, and the stock is down to like 15 something, I think, for Clean Spark.
Sure. I
Yeah.
wonder if he switched to just selling covered calls. I wonder if he's running the wheel on it.
Oh, I
instead
think
of
so.
just
Yeah.
Okay.
Yeah. Yeah, and then he got assigned on TNA. TNA is one I'm in actually. That's not a bad one. And then Riot.
Yeah, he has a really fantastic success rate.
Yes.
When you look through his trading history and stuff, this is what an experienced options trader is capable of. You know, you don't win 100% of the time.
Right, but as long as you
And-
win the
and-
majority of the time.
Yes.
Yeah.
Yes. As long as and your losses are small. If you keep your gains frequent and your losses small, you'll make out like a bandit.
Yep. Okay, so we've got some comments that, let's see, those of us who are retired would like income but without NAV erosion. I know, wouldn't we all? He says, I've had a growth portfolio for 40 years. Now it's time to transition to income. I get that idea, but, like I'm saying, I just can't get past that example of NVIDIA, like 250% versus the 120% in NVDY. And then a better tax treatment, owning it for over a year, long-term capital gain versus ordinary income tax.
Yeah,
So-
what my dad does is he just sells he follows the 4% rule. He just sells a small percentage of his portfolio every year to live off it.
Yeah, exactly. So you can still be
Yeah.
in growth and just follow the 4% rule.
Yes,
Yeah.
yes. And theoretically, you should not run out of money by the time you die if you're only selling 4% of your portfolio every year.
Yeah. Exactly. So, yeah.
So if you are hunting for dividends, and you are, like the beginning of your retirement or approaching retirement, I always try to tell people, and I'm not a financial advisor. I've been doing this a while. I tell people to hunt for companies that are buying back shares and drowning in cash, because then they're more likely to increase their dividend over time.
Mm-hmm.
So every time they buy back shares, they make it easier to pay their dividends, their distributions that they hand out. And after several years of this, getting easier and easier to pay their shareholders, they're likely to start growing their dividend. And then if you get into a company that is already growing their dividend at a significant rate while buying back shares, while having a competitive business model and strong cash flow, you can be pretty confident that they're going to keep doing that throughout your retirement.
Mm-hmm.
The poster child for this would be Altria Group.
Yeah, I was gonna say, Altria.
Yeah. If you bought Altria Group back in like the late 80s or early 90s or something, you have made out like a bandit. Like you're busy collecting an annual yield that is higher than your initial cost.
Mm-hmm.
So, I mean, let that sink in, and all you had to do was, wait 35 years.
Yeah, so if you bought it in the 80s, then yeah.
Yeah. And so as I'm approaching my retirement, I'm looking for companies that are sort of in a similar situation now to what Altria Group was then,
Right.
Drowning in cash, competitive business model, no need to advertise, because they rely on word of mouth. They rely on happy customers telling other people about their products and stuff.
Right.
And steadily increasing their dividend every year. Because another thing you have to worry about in retirement is having your wealth eroded by inflation.
Yes.
Yeah, that's a perpetual problem. It's not going to go away. We complain about the rate of inflation, but let me tell you, the Fed targets 2%.
There's always inflation, anywhere from 2 to 4% a year. It's just we're at like record highs the last 2 years.
And that's because we have a fiat currency.
Yep.
If we didn't have a fiat currency, if we were still tied to like metals, like gold or whatever, inflation would still be there, but it would be far less of a problem.
Right.
And they tied us to gold for a reason, and then they untied us from gold for a reason. And the reason they untied us and switched to a fully fiat currency is that now the Fed has a lot of additional tools available to protect the macroeconomy from downturns and black swan events, and to help us recover from such things. Back before the 70s and stuff, when we were still on gold, it was very difficult for them to help us all as a group recover from major problems.
Yeah, like I feel like if we were still on that standard, then the crashes would we would just crash, like stuff would go bankrupt, and then we would just have the fallout from that.
Well, and
Yeah.
crashes used to be a lot worse. Like if you look back to like the 1929 crash,
Yeah. Great
it was
Depression.
devastating.
Yep.
Yeah, it was devastating, and that was due to too much leverage in the system, and everything delevered.
Well, and like we were just talking about this too, like from '08 and '09, I think they've learned a lot because that banking situation last year, they made that a lot smoother than it could have been. That could have been
Yeah.
a major deal.
I was expecting hundreds of bank runs, and we got like 2, 3. I was
Exactly.
expecting a lot more.
Yeah.
How you doing, Polly? Polly just joined.
Oh, he joined.
Good,
Welcome. Welcome.
Yeah.
You're on the live show.
The live show, the live coaches show, hey?
That's it, yeah.
This is the place to be on Saturday night, huh?
This is live coaching, yeah.
Wow.
Yeah.
So
So,
what
yeah.
did you want to chat about, Polly?
Well, I was telling Coach about those growth funds. I was just trying to find any new growth funds that are following existing ones that are doing good. Because a lot of times you get like I was looking at that one for was it the Vanguard VIG, right?
Mm-hmm.
Then there was another one that was very similar to it, and they're both are following the same index, but the one that I found is actually a couple years older, and it's got a higher expense ratio, but
What was the
it
ticker?
follows the same index, and I put it in the chat there, buddy.
Oh, I know. Yeah, I gotta probably scroll up.
I put all those in the chat.
Yeah.
It's basically VIG versus RDVY.
Oh, that's right. Is there one you called it PAVE? Because I made a joke about like
Pave is a.
I said
was just looking
something.
at
I said
industry
something. Oh yeah.
specifics too.
Yeah, I made a corny joke. I said it will pave the way for your financial future.
It'll
or
pave the way for my financial future. Yeah.
Yeah.
But I know the expense ratio for RDVY is higher right now because it's a newish fund, but it's also got a higher yield than the other one does. So
Oh, that one's the best one over the last year. 48% price return. Let me look at total return. Now, Blake, you were saying the total return is just taking like the cash dividend and adding it to the price return.
Yeah, when I use Seeking Alpha, I have yet to figure out how to look at a chart that includes drip. And I'm pretty sure that when you select total return, it does not include dripping. It just includes the value of the distributions versus the share price. There's no like automatic reinvestment calculation.
Someone put another tool in the Discord. I probably have to scroll way back, but they mentioned another thing to use for calculating dividends.
So something I think you should do with your Discord is produce a channel that only you can make posts in. And then anytime someone in the Discord posts a really useful tool, copy it into there.
Okay.
couple links or
and then-
something. Yeah.
Yeah, just a whole channel of just links to useful tools.
Mm-hmm.
Yeah. I know there's a ETF. There's an ETF one I use that compares what's in certain ones, right? For instance.
Because what I was trying to
And then
do
it tells
a
you
while
the
ago.
ratios and stuff.
Yeah, what I was trying to do a while ago was very manually intensive, but I was just doing it myself, like with Tesla. I did a couple of videos on this where I was, saying if you dollar cost average the dividend back into it,
Yeah.
you would have been at this level. But it's a very manually intensive effort.
Right. Yeah, I should encourage you again to just start a sub-channel that only you can post into, and then anytime any of us post a useful tool, copy paste it into that sub-channel so that all of us can reference it.
Yeah, that makes a lot of sense. I'll do that. Yep.
So you were talking, Paulie, you were talking about growth and hunting for ETFs that are growth focused. So
growth focused. Yeah.
about 3 months ago, I was having a conversation with Debt Slave about cash flow based ETFs that choose companies that are cash flow heavy. And I was telling him, I'm like, I mostly hunt for small caps and micro caps because I'm after that growth potential, because the mega caps, like the Magnificent Seven, I really don't think many of them are going to be able to 10x their revenue, over the next 5 or 10 years or whatever. But some of these smaller companies, they might. And one of the strong indicators for that is cash flow. And so the next day he got back to me with a ticker for an ETF that I should check out. And it's SFLO, SFLO. And so this is small caps with significant free cash flow.
Okay, let's
SFLO.
see. Let's have the coach pull that up over
yeah,
some
go-
stuff here and take a look
Victory
at
Yeah,
shares,
go ahead and-
small cap, free cash flow. I like the name of that.
Yeah. And so, if anybody anywhere in Discord or on YouTube, if anybody knows of other ETFs that choose strong cash flow, I am interested in that, especially if it's weighted by like free cash flow yield, and especially if it hunts for micro caps and small caps, because there's a lot more opportunity to be had down in the smaller world where the companies are just plain newer. They're not as well established as like Nvidia or Tesla or Amazon or Google or any of those. If you want huge growth, it's really nice if you start small, stuff like that.
Yeah, because I wonder if you compare that against was it VONG, right? But
Sure.
that's on the Russell, isn't it?
VONG.
Same thing, right?
Oh yeah,
Yeah,
the Russell
yeah.
1000, or even like TNA or something. Well, that's a triple X. I could just do.
So you could look at seeing what index that might go off of. It might be
IWM.
index based.
I would think IWM.
IWMY. Yeah.
Yeah, but
Or
this is
IWM, yeah.
specific companies, though, isn't it? Like based on their cash flow. Let me look at it over. Let's see how long it's been around. It's the pink one. Oh, it's very new.
Yeah.
Yeah.
Right. And I've been hunting for. I've been researching individual companies for years, not ETFs, but I've been hunting for ETFs that are cash flow based, and this is the only one that anyone has pointed out to me that exists already. I'm sure there are others. I just don't know about them.
Yeah. But yeah, these other ones. So this
Wouldn't
Vaughn.
cows, COWS, be the same type of thing?
People has brought up cows before.
It
Maybe I should take a look
amplifies
at 'em.
cash flow dividend leaders ETF. Now, whether or not it's got, you would have to check to see. Oh, CAF is another one someone's mentioning. But
We
you
got
have to
CALS
see how
and
that
CAF.
compares. Yeah, see how that compares those just
Pacer.
for the year to date.
Interesting.
I'm reading the description on cows right now.
30% in the last year.
So cows invests in dividend-paying stocks.
Okay.
I'm pretty sure S-Flow just ignores whether or not they're paying a dividend and focuses on the company's free cash flow. So that there's at least one difference.
I'm gonna start a new one over here because we got another one from the audience, VFlow. So you can do up to 7 at a time in a comparison. So I'll just start a new one.
Sure.
Oh, I should go over how they have it rated.
That one's
So let's see, for the VIG, let's do the first one. So the quants have it rated as a buy. The SA analysis have it rated as a buy. It's got a B for momentum, A plus, and A in all the other categories. Let's see the holdings would be. Oh, it's got a lot of the sectors of the SP: technology, financials, healthcare, industrials, consumer, defensive. Let's see who's this.
it's a bit tech heavy though. That's a problem.
Yeah.
I mean, it's 20. You always see these funds 25% most of the time, right? Nowadays.
Yeah. Okay, I see we had
Check those
Amero,
guys.
Amigo.
Amero.
Just hang in there. We'll get to you in a second. We're just gonna go over these real quick.
VFlow looks like it invests in large caps.
Chat.
Yeah.
Yeah, I'm after small caps and micro caps.
The S-Flow primarily is 30%, almost 30% energy, 18 consumer, 14 industrial, and 12% healthcare, and then only 10% technology. Okay, so that's actually not that bad of a mix.
Mm-hmm.
Sure.
It's got defensive, communication, and like a tiny bit of financials, but that's actually a pretty good mix.
The VFlow's beating the S&P over the last year.
It's got Dillard's. Take a look at what Dillard's has done over the last 5 or 10 years.
You know what's funny? So I thought Dillard's was a dying business. It's one of those mall stores.
Yeah.
And I guess it's making a comeback, but it was on the decline for a while before then.
Well, the Dillard's is a buyback story. They have been buying back so many shares that their earnings per share just keeps going up.
Mm-hmm.
even if their revenue, because the revenue's been, I don't know, pretty flat over the last decade.
Yeah.
Revenue hasn't really changed, but they've been buying back shares like mad, and that tends to make the share price go up pretty hard.
Mm-hmm. Oh, that guy dropped off because I guess I didn't.
So S-Flow hasn't beaten the S&P 500 the last 3 months. It's still trailing it by a little bit. I mean, 8% in 3 months, you can't complain, but still.
Yeah. I mean, there's nothing wrong with 8% over 3 months. That's pretty good.
Yeah, you can get that in Yieldmax too.
Oh, there we go.
Yeah.
There we go.
Oh, you asked another question too in the chat. Did you ask like how many of the Yieldmax ones were down?
Yeah, how many are they? You've been counting that.
I tried to because
one of your videos.
Yeah,
16 out of 22 now.
Yeah, because I'm starting to cover growth and dividends, and so I get a lot of commenters that say, "Oh, you keep pointing to the ones that are down." I'm like, "No, I say it's. I think it was 17 of 22. Maybe it was 16 now. Yeah, one went into the red, I think. So I'm trying to keep that view up over here in Seeking Alpha. So here's a batch of 7 of them. Let's see. I'll just go to like maximum. GUI is down. Oh, this is only price return. Let me go to total return. But then again, we have to factor in dividend reinvestment. What?
Coach, in addition to making videos where you cover which ones are positive and negative total return, I think it would also be wise to make a video at some point where you talk about which ones have actually managed to beat the SPY.
Yes.
That would be interesting.
That is true. That is true.
And I sort of bet it's the other way around. I'd be willing to bet that only 4 or 5 of them are beating the SPY, something like that.
I can say off the top of my head, so MRNY is, MSFO is almost on pace with it. AMZY. But I know...
probably be getting up there now.
See, the thing, and FBY too, but the thing is I know these underlyings are doing way better than these.
Yeah, I mean, I understand when you compare them to their underlyings, they're not going to perform as well, but the real question is how well are they going to do versus the SPY, and that's the market. That's what people say, when they say the stock market.
That's the standard, yeah.
Yeah, they usually just mean they usually just mean the S&P 500. And if you can beat the S&P 500, let me tell you, you're doing pretty good.
Yep.
Well, that's a monthly dividend. S-Flow is.
Oh, is it? I didn't even look at the dividend on it.
Yeah, not much of 1.18 of a yield.
Sure.
And it's only a small assets of less than 50 million.
Yeah, I just really liked the concept. I mean, I don't own any S-Flow, but I really like the concept of choosing small caps that are high cash flow, because they're either going to use that cash flow to grow, or they're going to use it to buy back shares, or they're going to use it to grow their dividend. It's hard to say.
Here's another one here for you. FCFY, First Trust S&P 500 Diversified Free Cash Flow.
FCFY.
Look at that one. FY. Yeah.
Boy, this thing is new.
Did you all hear the live show when Capital Mindset and Kale were on, and we were talking about what was it? FOR. I looked at that one. That looks like a pretty good stock. I actually bought some of it. And then we talked about one of the suppliers for Tesla, Modine. That one's up like 300, almost 400% over the last year.
FOR, you said?
Yeah. I think it's
I'm gonna look.
4-star. Yeah.
Okay. Yeah.
I liked what I saw, so I bought some shares of it. And then Modine, of course, is really high right now. But if you look at it over like the past year, it's done 380%. It's a supplier of Tesla.
Okay.
Yeah.
Okay.
Yeah. So that's where like the gains in Tesla were with one of the suppliers, at least one. Yep. Like if you were looking
4-star's done really well.
Yeah. Yep. So FCFY is here.
Yeah, FCFY.
Yeah.
So it does track an index of S&P 500 sector neutral FCF index.
Okay. Sector neutral. Okay.
Yeah, but it's literally brand new. It's only got 1 million under assets.
Oh yeah, assets under management or something. Yeah. It's got some tech, financials, consumer cyclical, healthcare, communication, industrials. Yeah, looks like a good balance. kind of weighted
See what
towards
it's
tech.
up. See what it's up though the last 6 months.
Yeah, let's see.
It's not bad. It's not bad. 19%. The S&P is 22.
Mm-hmm. This is FCFY.
Yeah.
You're saying it's
only
up?
20.
It's up 19 because it's
22.
showing. Wait, it just went.
I think it just started trading like 3 weeks ago.
Oh, yeah.
Was it closed in before or something?
Maybe.
Yeah.
Yeah, because it started at 20.46 and then now it's up to 22.97 in a matter of 6 months. 8 months.
It's funny, this commenter, I thought he was making like a, I thought he was saying something else. It's actually a fund name, OMFL.
Oh, yeah.
Okay.
Yeah.
Okay.
I thought he was saying like
Yeah. That one's-
OMG or something.
That one's comparable with people invest in that, cows, BONG.
Mm-hmm.
Those are the big guys that they like to. I don't know, that FCFY, it seems like an interesting one to put on a.
Let me look
What do
at
you
their
think of that
holdings.
one, Blake?
Yeah, I'm looking at their holdings right now. They're a little tech heavy.
Well, they're 28. So most of these funds, it's at least 25. So it's 4%,
Yeah.
5% more than normal. And then financials the next one.
Mm-hmm.
Yeah, let me read their summary. It's S&P 500 diversified free cash flow. So it's large caps and mega caps. Is it
Yeah.
weighted? Is it weighted by free cash flow? Hang on. Let me read a little further. It says it was formed on August 23rd.
Okay, so that'd be about, yeah, that's about right. I think it's August, September time frame. So
Yep. Yeah, these
Highest.
look like. Mm-hmm.
Yeah, they go after companies with the highest relative free cash flow yield within each sector. Wow, this is pretty interesting.
Mm-hmm. CJ Navage says FCFY has a dividend yield of 0.98% and paid 23 cents per share in the past year. The dividend is paid every 3 months, and the last ex-dividend date was March 21st. Okay.
Yeah, it looks like Seeking Alpha has only been tracking it for
a little while.
Yeah.
yeah.
Yep.
More recently,
Get
they
portioned
started.
apart, right?
Yeah, they only started covering it more recently.
Mm-hmm.
That's probably just because it has such a tiny amount of assets under management.
Yeah.
Would that be something you'd be looking at, Blake? Something like that, possibly.
Yeah, possibly.
I know it's new. You always
Yeah.
want to see the AUM be a little higher before you invest in things, right?
Sure. Yeah, I want to see some time to prove performance. You don't just want to like. So I give people the speech all the time about how you shouldn't just treat an investment like a black box. You got to open up the black box and take a look at how all the gears work on the inside of the machine. And often that's good enough, and you can just jump into something that's new if you're confident that it's going to work.
Mm-hmm.
Yeah. You should get Blake to see what he thinks about AIRR.
Let me look it up here.
AIRR is and then that other one.
First Trust RBA American Industrial Renaissance TM ETF.
Yeah. So this is a sector play I'm doing, right? I'm gonna put some money into this because
It's got 3 6s in the share price, so I'm a little iffy.
oh, here we go.
So it says it focuses on industrials, capital goods, construction, and engineering.
Yeah, right
Yes.
there, engineering
Yeah.
Blake. Hello,
Yeah,
this is your
yeah.
fund.
Oh yeah. Yeah, electrical equipment, machinery, commercial and professional services, commercial services and supplies, financials, and bank sectors. Huh.
The quants have
I've
it
never
as
heard
a,
of this.
as a buy.
Yeah.
Seeking
So
Alpha has it as
I've
a
been
hold.
tracking this for a while,
Yeah.
How about
and I
this?
missed out on it this year because it's just went crazy this year.
Yeah, so
first
ranked
couple months.
ranked in subclass 2 of 25, ranked in asset class 13 of 402, overall rank 52 out of 2471. That's interesting.
Seems fairly good. The Seeking Alpha analysis, it's a bunch of people giving it holds.
Yeah.
It's just,
Well,
yeah.
Yeah,
Mhm.
I bought a little. I got about 4 or 5,000 on it. So,
And the
Sure.
quants have it as a buy.
well, it's been what, like 17% average year over year for the last little bit,
Mm-hmm.
Yeah.
and it's got a lot of funds. Like even one of the funds that were in it, I looked at one of them, and it was like 17, 20% year over year, right,
Oh wow.
for the last 5 to 7 years that
Mhm.
it had in here, right? So, yeah,
Let me look at the.
that's what I was thinking.
Let me look at the holdings.
Oh, 80% industrials.
MCore, Bluebird, Comfort Systems, Powell Industries, Mastech, Sterling Infrastructure, MDU Resources, Encore Wire, Hubble, Dicom. I've never heard of any of these companies, but that doesn't mean they're not good. They could very well be really good companies.
I don't know. I usually, if I haven't heard of something, it can't be any good.
Can't be any good. Yeah, yeah.
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 But that's
I
what I
know.
thought. Like that's a sector-specific one, right? To try.
Yeah.
Yeah.
And it's not like look what the technology is 5%. So because every time you buy a fund, right? Lately, they put technology at like at least 15 to 25% in the funds, right?
Yeah.
And what's technology going to do, right? So that's why I try and put
Well,
5 or 7% little chunks in certain things,
Yeah, the problem with the technology sector as a whole is that very likely the top players today are not going to be the top players in whatever that industry is 5 years from now. And then
Right.
5 years from now, those top players are probably not going to be top players 5 years after that. It has a really high replacement rate where a company will become top dog because they have the best technology, and then 3 to 5 years later, they get replaced by somebody else.
Mm-hmm.
So industrials, this looks far more stable because it focuses on industrials, and that's a much less. There's much less change in that industry.
Yeah, so that'd be like you needing parts for a windmill or something. You're always going to be running a wind, like I mean that as an example, right?
Yeah.
Mm-hmm.
What was the other one I gave you, Coach?
Oh, let me look at. I think you private messaged me.
Dave was the other one we wanted him to look at.
Oh yeah. This has such a great name for punny jokes.
Oh, it is, isn't it?
Yeah. Oh, it's an infrastructure fund. Yeah, it's doing about the same as Air over the last year.
Now this one's got Parker Hannifin, which was that PH company I talked to you about last
Oh, that's
time I
right.
talked to you, Coach. That's the one that was doing 17%. You know what I mean?
Mhm.
Growth year after year for the last little while. So, but more than likely, that's in the other fund. But just because it's it may have less holdings, it may only be a less percentage and things like this, right?
Mm-hmm.
Yeah, Microsoft has been a top dog for 30 years. So we're talking about growth ETFs.
Yeah, so the good thing about Microsoft is that they're going to continue to crush the opposition or buy them out. That's how it's kept them top dog for a long time. The bad thing about Microsoft is they've already 10x their revenue a couple times, and I don't really see them continuing to 10x revenue at the same pace that they have in the past. They're a fully mature company. They've reached saturation. If they're going to grow revenue and find new customers, it's going to be like in developing countries or something like that. Most of the Western world already uses Microsoft.
Mm-hmm.
Or they'd have to go crazy with R&D to develop something that just everybody has to get. Like,
Yeah.
What Apple did 10, 15 years ago, right?
Yeah, well, and so for example, with Apple, they're working on the first generation of augmented reality glasses, which are really heavy, really expensive, and really impractical. But by the third or fourth generation of that technology, it's probably going to be the next smartphone for them. Like 15, 20 years ago, smartphones were just becoming a new thing. And nowadays, basically everybody has a smartphone. I think that in another 15 or 20 years, augmented reality glasses will be something that most of us are wearing, and it will have been normalized,
Mm-hmm.
As you drive down the street, it'll give you directions. When you walk into a store, it'll display the prices on all the goods. That there's a lot of potential there, and so I don't see Microsoft making additional like revolutionary change like Apple has a history of doing and is going to try to continue to do.
Mm-hmm. So we got a comment about Tesla. This person says he's loading up on Tesla because he thinks it's cheap right now.
What's it trading at right now? I'm not sure.
It keeps
See, I
dropping.
regularly talk to Tesla bulls.
It was at 160 at one time.
164.90.
70.
Yeah.
Yeah.
Yep.
So the last time I did an intrinsic value calculation on Tesla, it was at like $75 a share. And so if it ever drops to like 50, I will be in there buying with two hands.
Mm-hmm.
But, you know, I'm picky. I only choose to buy things when they're really, really cheap. You know, when they have to be seriously on sale for me to step in and buy it.
Mm-hmm. A commenter says Tesla is going to 10.
Well, could very well, right? I
That'll
mean,
be another reverse
it's-
split then.
Well, you got to look at what's going on with their cars and stuff. Like if they don't hit their next target,
Yeah.
then what, right?
Yeah, true.
I mean, that's the biggest thing. So they're hoping on rates going down, you know, 4% maybe.
Mm-hmm.
Yeah.
Maybe they'll get a lot of, but it's a huge purchase, right?
Yeah. I'm definitely really bullish on their long-term potential, but I think they might have a rough couple of years. You know, like Tesla has 5 or 6 of these alternate income streams that they've been developing for a few years now. They've got AutoBidder, where they're going to arbitrage electricity. They've got full self-driving that they might be able to lease out to other car companies. A lot of people don't talk about this, but they have been developing really efficient manufacturing for many years now. And so it's very possible that another company like, say, Whirlpool is going to ask Tesla to build them a mostly automated factory. And so there are aspects of Tesla where I believe that years from now, they're going to be a fantastic company with a bunch of different extremely highly profitable segments.
Mm-hmm.
But right now, they're basically like 90% of them is just a car manufacturer, and, you know, and that potential is still there. But I worry they're going to have a rough couple of years before they get those other revenue streams like truly online instead of just like in the infant stages like they're at right now.
Mm-hmm.
Yeah. So what do you guys think of that PAVE ETF?
Oh, let me go
Pave?
back to it.
Yeah.
Commenters keep trying to distract me with Tesla.
All right.
Yeah. They're saying the title says Yieldmax versus growth. We're talking about both. Don't worry.
Oh yeah,
Yeah.
oh yeah.
Yeah.
I noticed Dissector's in the chat now. Dissector, I want to thank you for shouting out High Tide during the Cashflow Kings appearance that you made earlier tonight.
I only saw a minute or so of that because I was out. But yeah, I made a comment on there. But I didn't. I guess he was on there. Yeah.
Yeah, he was on there. He at some point, like about halfway through, he was like, "People should just be buying High Tide."
Yeah. Yep. Oh, all right. So PAVE. Let's see here.
Yeah. See what your stuff thinks. What do they think about it?
I haven't used all of my analytical tools yet. I haven't broken out the
here we
advanced
go.
equipment
There
yet.
we go.
So I'll let you know what that says. All right, over the maximum 170% over the life of it. Well, this isn't a fair comparison because it's showing like 1,000% for the S&P, but that's since like it's got it since like 94, like the past 20 years. All right, let me type it in up here.
Boy, it's had a pretty good year. It's up 48% over the last year.
Yeah, it's almost double the S&P over the past year. It's kicking the S&P's butt this year.
That's the infrastructure probably bill that you guys passed in the States, right? That could be
Oh,
part
it's
of that.
benefiting from
Yeah.
that. Yeah.
Yeah,
quants,
the Inflation Reduction Act.
the quants
the-
have it as a buy. Seeking Alpha analysts have it as a buy. It's got an A+ for momentum, C for expenses, C for risk, A for liquidity.
It's also had a fairly attractive 5 years, up 144%.
Yes. Oh, so it's been around since March of 2017. Interesting. Okay, yeah. Most of its growth came within the last 5 years or so. Interesting. Does it pay a dividend?
Does it pay a dividend? Jeez, that's not a Yieldmax dividend payout, buddy. Come on.
Oh, I know. It's just, dividend. Oh, it does pay a dividend. There we go.
Yeah.
Yeah.
Semi-annual.
Yeah.
There you go.
Oh, I forgot to mention, so when I keep talking about NVIDIA and harping on that, NVIDIA stock also pays a dividend too. It's very small, but it does pay it.
That's right.
It's so small they might as well just keep it.
Yeah.
Yeah.
Oh, look who's on.
Yo, what's up, guys?
Welcome. Yeah.
Right.
Yeah, I have something to say.
Yeah, go for it.
That's like you are an idiot.
I was almost going to pull that up myself.
Yeah.
Yeah.
How are you guys doing?
Great.
Oh,
How are you?
Pretty good tonight.
Great.
You're making the rounds tonight, I see.
Yep.
Yeah.
I got all these appearances.
Yep.
When's the check hitting for this one?
The check for this one,
Yeah.
that I'll send some fake money. Yeah.
Monopoly money?
Coach
Yeah.
Get you
currency.
that
Yeah.
cash outfit he was wearing the
Yeah,
other
Monopoly Matt money.
Yeah.
We'll
Oh, that
mail you
cash
some get out
shirt.
of-
That cash shirt was
We'll
an
mail you some-
expensive shirt.
Oh yeah.
Mm.
Coach, where's your money sunglasses?
Oh, right here. So when I wear contacts, I wear them.
Okay.
Yeah, they're
You're not
sitting
wearing your
over here.
contacts right now.
Yeah. I think I need to wear those more though. Like they were a hit. Yeah, they're right here.
Yeah.
Yeah.
They're the right kind of kooky for me. I really get off on like people being intentionally different.
Yeah.
Yeah.
I was doing a lot of that early on, but I'll get back to it.
Hey, Blake, what do you think of the cash flow kings earlier? What are your thoughts on the discussion?
I really like the discussion that they were having. If I wasn't in the middle of doing a bunch of other stuff, I would have been able to pay more attention instead of having to watch the whole second half of the live stream after the fact.
Yeah.
Yeah.
I'm gonna catch it later. I was out. I couldn't watch it. I caught like a minute of
Yeah.
it, but I'll watch it later.
I really like those two guys that host it because they're open and honest and they're giving their honest opinions and just like all the rest of us, they're on a journey. The more time you spend in
Investing
markets,
journey.
Yeah.
yeah. The more time you spend in markets, the more that you realize that there's always more to learn. So
Yep.
Yep.
I
What do you think
really
about the Verizon choice?
Yeah, I don't know a whole lot about Verizon. I haven't done a deep dive into them. I did notice they were talking about a bunch of companies that I haven't researched before. Like I know Walgreens exists. I've never researched Walgreens. Like I've never done a deep dive on them. I have yet to do a deep dive on MPW. And same with
Yeah.
Verizon. I've never done a
Yeah, I
deep
couldn't
dive on
talk about
Verizon.
Yeah. What do you think of the philosophy though? Just like, hey, I'm just gonna buy it because it's below fair value. Do you like that? Like in
I like
growth
that.
investing, or
Yeah, I like that a lot.
It really depends on, like for me, if the company also has a lot of promise. It needs, so like I have a checklist that I go down, and I should probably write this whole checklist down and like codify it, but they need to have, like I'm really picky. That's part of my problem. They need to have huge future growth potential, which means that merely buying something because it's really cheap is not that good of an idea. So it can
agree.
do. Yeah, it can do well for you in the short run, but I really prefer to hold things over longer time frames. Like, I typically have a 3 to 10 year outlook when I'm looking at companies. There are, however, instances where like you can make a boatload of money on a turnaround play. So Coach, go ahead and pull up a company called HDSN. This is the poster child for what a turnaround play should look like.
Hudson Technologies.
Yep.
Okay.
Yep. Go ahead and pull them up. Go to like a 10-year chart, or I think a 10-year chart.
Oh, it's like a U-shaped chart. It's like
yeah.
That's cool. 265% over 10 years.
Yeah. Get rid of the S&P 500. I think that's like
It always
comparing
defaults. Yeah.
Yeah. I think it's not showing what I want it to show. So this company almost died.
Mm.
Yeah, they almost died. Find the lowest share price you can, Coach. Or maybe leave peers. Maybe go back to summary because it'll show you dollar values. So this company, they recycle refrigerants for a living. So they will show up. They will drain all the fluids out of your refrigerator.
82 cents.
They will
Yeah.
replace it with refurbished liquids.
Mhm.
And then they will go back to their facility and dump that liquid into like a big recycling cleaning solution sort of thing where it refurbishes the liquid and then they go sell that liquid to somebody else.
Mm-hmm.
And in what year was that? 2018 or 2019 or something like that?
Yeah. Oh,
There
65
was,
cents, actually.
Yeah, there
Yeah.
were several refrigerant producers in China that decided to flood the market with refrigerants, and they dumped a huge amount of refrigerants on the market. And this company holds a lot of refrigerants in its inventory. And so when the value of those refrigerants were suddenly cut by 60, 70%, the value of their assets went down dramatically. The amount of money that they could make by changing refrigerants went down dramatically, and this company literally almost died.
Mm-hmm.
But they recovered. This is a turnaround play. This is something that if you're going to look for cyclicals, this is what you want to see. You want to see a company survive a major stress event. And if you manage to buy it after the stress event is over, and it looks like the company's on a path to recovery, you could make huge gains. But you have to, your timing has to be good, your assessment of the situation has to be good, and the company has to be well managed in order to survive such an event. So this is the company I always point to where I'm all if you're going to look at cyclicals, if you're going to look at companies that are heavily dependent on the price of a commodity, the time to buy those is when they're on death's door.
Mm-hmm.
And but look at them now. They're kicking butt. They have strong margins and strong cash flow. And one of the things that happens when these companies get put on death's door is they look for ways to become more efficient. And so it's always attractive to find companies that have survived multiple black swan events within their sector. Not necessarily black swan in the whole economy, but black swan in just their sector.
Yep.
Because those companies have found a way to do it, whatever that means.
Mm-hmm.
So if you'd have bought this back in, during the troubled times when they almost died, you would have made, I think I did the math and it was 25 or 30x returns. You would have made huge money.
Yeah, from 37? I see 37 cents here. All the
37
way to,
cents.
Yeah, all the way to 10.60 today.
Yeah, huge
That's not bad.
multi-bagger. Yeah, huge multi-bagger. And all you had to do is wait 8 years or 6 years or something like that.
Oh, it's pulling back a bit over the last month.
Yeah.
Yeah.
Maybe that's a good buy.
Yeah,
It
look
could
at
be.
that. Yeah, 26%. Yeah.
Yeah.
So
Yeah.
Blake, what are your thoughts on momentum investing? Because that's kind of the point I was trying to make to him. Is it's down, but it has no momentum. So how long is it going to take for it to recover? So I like to use momentum as part of my analysis. Do you ever do that, or
Yeah,
what's your take on that?
so if I want to get into something, for a fundamental reason, I will typically wait for multiple red days in a row, and then I'll buy on the first green day. And I don't know if that's the bottom, but it sure has produced instances in the past where I have basically bought the bottom on some stuff. So you can't really tell the future, we all know this. But all you can do is dollar cost average in at attractive buying locations. And sometimes you end up buying a falling knife, and sometimes you end up buying the bottom. And you're taking a risk when you do this, right? So I have not had nearly as much success as a swing trader as I have as an investor. Once you adopt a long time frame outlook, if you buy something when it's cheap, right at a bottom, right? Because you don't know if it's the bottom, you just know it's a bottom. And then if it goes down more, you have the opportunity to buy more. That's great. Now it's on sale for even cheaper. But if you have a short time frame outlook and you're trying to buy bottoms, you can really get burned, badly.
Yeah.
Because are you just taking this trade because of technical reasons? Or are you taking this investment because of fundamental or financial reasons? So
Yeah.
it really kind of depends on your outlook. I don't like to buy falling knives, but I will buy turnaround plays after it's clear that they have turned the corner, not in the middle of turning the corner, because that's burned me a few too many times, just trying to time the bottom and stuff.
And that's how MPW makes me feel. That's what I feel like that play is.
Yeah.
It's at the bottom. It hasn't turned around yet.
So it could be one of these same plays.
Yeah, if you're buying what you think is the bottom, be prepared to buy a future bottom that is even lower, because you have to psychologically get ready for that. So if you have high conviction in an investment, then you have to adopt a stance where it's like, okay, well, if it goes up, great, I already have a position in it. If it goes down, great, I'll just buy more cheaper, you know. But if
Check
you
this
don't have
out.
if you don't have high conviction, then you're typically setting yourself up for failure if you're investing into stuff that you don't truly believe in.
Check this out on Seeking Alpha. I've never seen this alert before. It says MPW is at high risk of performing badly.
Yeah,
Learn
I've
why.
definitely seen that alert before.
Really?
Yeah, I think that was
Yeah.
on 3M as well.
Yeah.
Oh wow.
Go ahead and click on it, Coach. It'll explain to you
Yeah.
why.
F.
Yeah.
Yeah.
That's
So
why I
that's-
like momentum.
Yeah.
That's
Yeah.
why I use momentum.
Yeah.
Yeah. That's based off of the share price changes, and Seeking Alpha just has this automated alert that kicks up anytime a
Interesting.
company's in sort of a doom spiral where it just keeps going down and down and down.
And 3M has that too.
Yeah, if you
Or it
have
did.
high conviction on a company, this could actually be a buy signal. You know,
Yeah.
like if you truly believe they're about to turn the corner, it could easily be a buy signal.
Mm-hmm. Yeah, because it seems like, I mean, medical properties and stuff, like, it doesn't seem like a bad thing. I mean,
Well,
What happened to them?
isn't this
They
a
got their
REIT?
dividend, or what they do?
Yeah, it's a root.
So one of I haven't done a deep dive on it, but from listening from other people, one of their leaseholders that pays them money is on the verge of declaring bankruptcy. And so there's a lot of fear and uncertainty wrapped around whether or not that leaseholder is going to continue to pay MPW the rent.
oh, so the whole commercial real estate market might be affecting them. Like the
Yeah,
post-COVID.
and
yeah.
And I'm not sure which leaseholder it is. You know,
Yeah.
I don't know if it's like a hospital or who it is
I thought
that's
it was
about to go bankrupt.
I thought it was a hospital or something like this in Australia, but maybe not. I don't know.
Yeah, I don't know. I haven't researched them well
Yeah.
enough.
Apparently, there's some scandals too. So
Yeah.
Oh,
apparently,
perfect.
that's what Fiscal says. They're like bullshit scandals. So he
Mhm.
thinks that's a major reason that it's underpriced. Because like on book value, it looks very attractive apparently,
Yeah.
and that's
Oh,
that's his thesis.
The book value.
Sam
yeah.
just hopped in. How you doing, Sam? I was talking you up just like 15 minutes ago. I was talking about you. You're the biggest Tesla bull that I know.
Yeah, welcome, Sam.
Hey, how you guys doing today?
So we're going to redirect back to Tesla again.
Sure.
Oh, no,
Yeah.
no,
I just
listened
want to
to
warn
it.
Sam that we're in a live stream, so like
That's fine,
censor
yeah.
yourself appropriately.
You were in
No worries, no worries.
You were in here last week, I think, right? Yeah.
Oh yeah,
Yep. Yeah, he was fine. Okay, let's see. Oh, I was looking for the financials of these here. Yeah, cash flow. Yeah, some mixed signs
Boy,
for sure.
Coach, you have more tabs up than I do.
Yeah, well, I like to just keep them
No wonder
open.
its computer acts so slow.
Yeah,
Yeah. Well, my MacBook's slower than the desktop, but I like to keep these views up, like the Yieldmax ones, because I constantly get asked now which ones are up, which ones are down. So I
Sure,
just keep them
sure.
up. Yeah.
You have like 50 tabs open.
You know, you
Something
can
like
do
that,
that in
yeah.
Excel, right?
I've never seen that.
You can
Yeah.
pull all the stuff from Excel.
What stuff?
Like you can pull all the stock
Put
stuff
the
from
links in
Excel
there.
Oh, well, I'm using
without even doing
They're
too
just
much
links.
stuff.
Google Sheets. I'm using Google Sheets. Yeah.
Yeah, I think maybe you can do
Yeah.
the same thing at Google. It's just like equals, and it tells you how to pull stuff
Yeah.
up through the stock market
Mhm.
based off a ticker.
Yeah, there's definitely a way to type in an equation into Excel where it'll pull up price action.
Oh
It'll
yeah,
pull up,
I've
like,
seen
the
that.
closing prices.
Yeah. Yeah. Oh, let's see here.
So you thinking, Blake, those choices I made, I talked to you about tonight, pretty good ones to maybe look into?
None of them have red flags. I think they're
Yeah.
all worth researching. I mean, personally, I would stick with more small caps and micro caps, but that's my personal bias.
Well,
you know.
I still got VONG on my list, buddy. So,
Yeah.
yeah. Just,
Oh,
little
back
bit
to the
here, little
point.
bit there and stuff.
Yeah, MPW. Yeah, the price of the book is phenomenal. A plus. Yep.
So I think the reason the share price dropped so much is because Wall Street hates uncertainty.
Yep.
And they will devalue any time that there's uncertainty with the future of a company. And I'm trying to get Sam to read Monish Pabrai's The Dondo Investor,
Mhm.
because he talks about that in that book. He talks about how the Wall Street gets confused between risk and uncertainty, and anytime uncertainty shows up, they treat it like it's risk. Because they don't really know better, and also because their finance instructors in college basically told them that beta equals risk, and that's just absolutely not true. You should everyone who thinks beta equals risk should go read Howard Marks.
Actually, I was going to say some of my classes, they were talking about beta. Like a beta of 1 was like equal to the market. Yep.
Right.
Yep.
Yeah, and high beta does not actually equal higher risk when you're choosing individual companies. When you're choosing ETFs, sure, I guess you can make that argument, but with individual companies, you have to treat a potential permanent loss of capital. That's risk.
Well, they also push efficient markets theory too.
Yeah, I don't believe in efficient markets very much either, except over really, really long time frames.
Yeah.
Like, 5, 10, 20 years. Markets are definitely efficient over long time frames, but over short time frames, Benjamin Graham had it right. Markets are voting machines. In the short run, it's a voting machine. In the long run, it's a weighing machine. That's one of the best quotes in all of markets.
Yep.
And we have the opportunity as investors to step in when the price is right. Like timing the market's really hard, but pricing the market is something that everyone can do. You just have to be willing to do a little bit of math and a lot of research.
So a commenter said Steward Healthcare Systems owns 50 million of them. I guess referencing MPW. But I agree, though. If you have strong conviction in this, it might be good.
Yeah.
Yep.
I think Fiscal Velocity was talking about how even if the company that leases goes bankrupt, they're still going to end up paying the lease.
Yeah.
Local government, not hospital, go out of business. They'll step in.
Yeah, it's
Hospitals don't go out of business.
Yeah, it's pretty hard for hospitals to go out of business because the city that they're in will subsidize them, will help them out. It's sort of like the big banks and the federal government. Sure, they'll let small banks fail, but they really don't like to let big banks fail because they need them there. They're part of the social infrastructure. So it's the same with hospitals and cities. If a hospital is about to fail, there's a very high chance that a city or even a state will step in and help the hospital.
Interesting.
Well, they need them. It's a too. It's not quite a too big to fail, but it's a too important to fail. You can't let critical infrastructure fail. You have to step in and rebuild the bridge or keep the roads repaired or whatever it is.
That's definitely a better to fill in the blank to fail of the ones we
Too important to fail might be the way to look at it.
Yeah. Agreed.
Blake, I have a question.
Sure.
So what's going on in Germany with for high tie? Because they're just now legalizing, right?
Yeah, so Germany is in the process of switching to a model where they're allowing recreational cannabis, and they're doing it in phases. And they refer to these phases as pillars. So pillar 1, they're allowing people to grow it at home, and they're allowing people to walk around with, I don't know, like an ounce or 2 on them or something like that. And they're allowing you to join like a smoking club. Coach, you might as well pull up high tide on the chart since I'm going to talk about cannabis for a couple minutes here.
We're getting into high tie for sure.
So pillar 1, they're allowing you to join like a club, and you can like pay annual dues, and then while you're there, you pay money based on your consumption. And this is going to be like a hookah bar type place where you're a member of this club. The club will grow it and supply it to you, the consumer. And so that's pillar 1. And I don't really know when pillar 2 is going to pass, but pillar 2 is when the door finally opens for High Tide and a bunch of other cannabis companies that want to get in on the action. So pillar 2 is going to allow small, like industry-specific retailers. So like right now in the United States, you can step into like a vape store and you can buy vaping equipment, you can buy liquid nicotine, you can buy all sorts of things that specifically support that industry. So whenever they get around to passing pillar 2 in Germany, they are going to allow cannabis-specific retailers, and that's High Tide. So High Tide they already trade on the Frankfurt Stock Exchange, and they have already formed a partnership with a company called Sanity Group to help them build out their discount model in Germany. And I'm not really sure when the German government is going to get around to implementing Pillar 2. But here in the U.S., we basically have 2 political parties and then a bunch of political parties that kind of don't really matter. Unfortunately, I wish we had more. But in Germany, they have like 8 or 9 dominant political parties. And this last election cycle, the two parties that did the best, that got the most votes, were both pushing recreational cannabis as their primary part of their platform. So for the last couple of years now, the German equivalent of Congress has been trying to hammer out a bunch of legislation to make good on their election promises. And they promised full rec. And one of the things that they did to help combat the naysayers of full rec is they agreed to implement it in phases. And so each phase, they're going to make it more and more and more available to the public.
So
Yeah.
I pulled up an article here. It says the German government has indicated it will now begin work on a draft law related to Pillar 2 of its legalization plan. Yeah.
Yeah, we all know how long it takes governments to do stuff. So
Yeah.
I mean, this could get implemented in 6 months, or it could take a year, it could take 2. But whenever Pillar 2 finally they get everything hammered out and they vote on it and they implement it, that is when the door finally opens for high tide.
Mm-hmm.
And so I view Germany as sort of like the Colorado of Europe, right? If you guys remember, Colorado was like one of the first ones to go full rec, and they sort of started this trend where other states are like, hey, we could use that tourism revenue, you know? And already there's been rumblings in France and Great Britain where they both are saying, hey, you know, we don't really want to lose tourism to Germany, and we think that once Pillar 2 gets implemented, there's going to be people driving to Germany just to purchase cannabis, just so they can drive back home, or spend a weekend there having fun and consuming it and stuff like that. And so, other countries in Europe are extremely likely. In fact, it's better than extremely likely. They are incentivized to also go full rec, so that instead of just plain refusing to lose the tourism revenue, they capture tourism revenue from the next country over. So the Czech Republic is also talking about doing something similar to this, and it's sort of going to cause this it's likely to cause this cascade of recreationalization in Europe.
Mm-hmm.
And everywhere that goes full rec, high tide will be there. The CEO has already loudly proclaimed that he's looking for new markets to expand into, and he still has plenty of growth in Canada that he can go into, because he has set the goal of taking the 166 stores they already have and pushing that up to about 300. And I'm not sure if 300 is going to be actual saturation or if that's the next milestone he's just gunning for, you know. I suspect it'll be another, I don't know, 3 or 4 years or something before they actually reach 300 stores. But if you look at their free cash flow margin and how much it costs for them to open a new store, they could do it in 2 or 3. It really kind of depends on if these new markets open up for them, then they're going to throw money at Germany. You know, if the U.S. opens up for them, they're going to throw money in the U.S. They're going to stop throwing money into new stores in Canada. But if the new markets don't open up, there's still plenty of growth potential inside of just Canada until they run out of small towns and suburbs to build stores into.
Yeah.
Mm-hmm.
Yeah, I'm definitely trying to learn more about the cannabis industry, because my portfolio now, like 2 of my top 5 positions are cannabis.
Oh, what's your
IIPR.
Oh yeah,
high-tie.
yeah.
I just got in on high-tie.
IIPR is pretty good for anybody who wants a dividend. You know, they're basically like a REIT, but they don't have to quite follow all the same rules as a REIT. In addition to owning property and leasing it out to cannabis companies so that they can use it for grow ops and stuff, they also hand out loans.
Hey, Dissector,
So-
do you want me to pull it up now? It's on the portfolio
Yeah.
chart here. Yeah. So yeah, you've got Amazon, which is your largest holding, right? And then you've got some
Yep.
IIPR and some high tie now.
Or wait, is that? Yeah, that's accurate.
Yeah. Yep. Cool. Yeah, SMCI. Yeah, that one's still.
Yeah.
It's pulled back a little bit.
So Blake, what do you think of that portfolio? Because Ryan's
Uh,
not a huge fan of it, but
Yeah, I haven't looked at it in
Coach
detail,
likes it. Yeah.
but I'm already seeing a bunch of solid companies and a bunch of good ETFs.
Yeah, there's a lot of these that like are on, I think, the Seeking Alpha ratings too.
Yeah.
And then Modine.
Yeah.
Modine, you're already up 40%. How long have you been in that
Yeah.
one?
I think a few months.
Okay.
So
And
I'm
then
newer to that one too.
you're in 4. You just got into 4, right?
Yeah. Yep.
Yep.
So,
And then-
so Dissector, you use Seeking Alpha as an investment tool and a research
Yeah.
tool, and
Yep.
I do as well, and I really like it because when you're thinking about a company or an ETF, you can get a bunch of different opinions on it. You know, you want to hear the bull case, you want to hear the bear case, you want to hear 5 or 6 different people's opinions on why it's good, or 5 or 6 different opinions on why it's not so good. I really enjoy it because it's a meritocracy. Because if those authors don't know their stuff, if they don't truly understand a company, then they're going to get shredded in the comments.
Yeah.
For sure.
I've seen that
For
a
sure.
lot.
Oh yeah.
I didn't
And
realize.
it has your track record on it. It has
Oh,
it
yeah.
in the comments. So.
Yeah.
Yeah, you can go to tip ranks and check out these people and find out if they actually know what they're talking about or not.
Yeah.
Yeah. Do you like Stephen Kress? Have you seen him?
I have. I
He's
think
the
I
head of quant.
I subscribe
he's
to
the
him.
Alpha Picks.
Yeah.
Yeah.
I'm
Do you use
really
Alpha
hope.
Picks?
I do not use Alpha Picks, but I do read Stephen Kress's articles because he'll come out with an article every once in a while.
Yeah, he's had really good performance. He has the Alpha Picks program, and I'm subscribed to that, and that's what all the orange picks are, just picks that I got from that.
Yeah.
Okay.
And
okay.
he has a really good track record. Like every year he comes out with his top 10 stocks, and usually they perform great. Like he's been on SMCI for a bit. I think Modine, Giga Cloud. There's a lot of good stocks that he's owned, so I like to follow him.
For sure. Yeah, I have learned a lot just listening to more experienced investors. It's, you know, like I was saying at the beginning of the live stream here, there's always more to learn in markets. And one of the best places to learn that is you find someone who's more experienced than you, or who's familiar with a sector that you aren't, and you just have a conversation with them, or listen to them, or read their articles, you know. Kress definitely knows what he's doing. I'm not sure if I'm interested in doing what he's doing, but he knows what he's doing, you know, and that's something that Seeking Alpha is good for. It's really good at showing you other people's strategies and other people's way of thinking.
So I didn't realize how successful the track record was for Seeking Alpha picks until within the last 6 months or so. It's really impressive.
Oh yeah. It consistently beats the market. Really consistently.
Yeah.
It's just very volatile. There's a lot of picks, and they'll be down 30%, but they have a lot of picks that go up 200%. So
yeah,
they're throwing darts, but most of them hit. So.
Hey guys, check this out. I just looked at my high tie, so I have call options in it, and I have the stock. I just posted it in the thread. Let me actually open it in a new tab. I didn't look at it. I didn't realize how well the options were doing too.
Oh yeah.
Check this out. Yeah. So this is my stock gain right now, and this is the call options and this is the initial investment here, 306.61.
What percentage are you up?
Let me see.
Which one of those numbers is your initial cost basis?
So the initial cost basis is so 306.61 is the cost basis for the options, and 2,941 is the cost basis for the stock.
Okay.
Yeah. So, and that's the gain over here.
Nice.
Yeah. I'm gonna just hold these. I think it's gonna keep running.
It has a strong potential too. Last week it took off like a rocket, and part of me was like, "Oh, this is it. This is the beginning of the next rally," and another part of me is like, "Nah, this is just a short squeeze."
I just have a feeling about it because it reminds me of, like I said in the video, I've sold too many of these too soon just to take the gain. I'm just gonna keep it.
Yeah. Well, so by the end of Friday's price action, when I got home from work on Friday, it was super clear to me this is not a short squeeze.
Mm-hmm.
Because if it were a short squeeze, it would have collapsed on Thursday and collapsed more on Friday, and there was no collapse. It was like it shot up like 70%, and then it dropped like 5%, and then it dropped like another 2 or 3% or something.
Yeah.
This is a bull flag consolidation, is what it looks like to me.
So it's a 65% return in the stock so far.
Nice.
Yep.
Nice.
Yeah, that's good.
Yep. Oh, and then we have
mostly
somebody.
20% I got on last week.
Should I review this
too bad
portfolio? Somebody posted
too bad
this
I
one.
wasn't, Coach. Too bad I wasn't talking to you a year ago, because a year ago it was like 55 weeks ago. I was buying High Tide shares at $1.04.
Oh wow! Yeah.
Yeah. And I posted all this bullish, high conviction stuff to StockTwits and to Twitter, and like no one listens to me.
Have you been following for a year now? I'm trying to remember.
I have been steadily dollar costing averaging into High Tide since near the end of 2022. I think I made my first purchase in, I don't know, November or something like that. I'm trying to remember. I could go back into my history that's on my brokerage account and take a good look at when I made my first purchase, but I think I first bought shares when it was around 230, and then it dropped to 175, and I loaded the boat at 175. And boy, I wish I would have waited another couple months, because it was trading down in the 130s not too long after that. And then eventually, at March of 23, one of the ETFs did a major sell-off, and they were selling off like a bunch of different companies. And because this is such a low volume company, it went all the way down to $1.04 for that sell-off. And I didn't know how far it was going to go, so I just put limit buys at every penny all the way down to 50 cents. And so I got filled at 112, 111, 110, 109, 107. I just kept getting fills, and I'm like, I'm happy, And if it had gone all the way to 50 cents, boy, would I have been extra happy, because that means it would have pushed my cost basis down that much lower. Yeah, those are some articles I wrote on High Tide.
Yeah, there's some. Yeah.
Yeah.
So even in November, it was like $1.17.
Yeah.
Go ahead.
Yeah.
Yeah. Blake, would you say High Tide is risky? What's your take on that?
Yes and no. So the company's financials and fundamentals keep improving, and it's already really undervalued. So if you look at them from a growth potential basis, I use the PEGI method. So Coach, go back to the company's tab. I know I love that you're showing off one of my articles, but if you go back to the company's tab and you click on valuation, right? So we didn't really have PE to look at, but we have EV to EBITDA.
Yeah. And
the forward EV to EBITDA is 8.21, and the forward price to cash flow is 10.56. Down. Yeah, EV to EBITDA and price to cash flow. Yeah. So the PEGI method that Peter Lynch developed uses PE, and I actually prefer to use EV to EBITDA and price to cash flow. So now that we have those two numbers, the 8.21 and the 10.56, scroll back up and click on growth.
So we got revenue growth, forward revenue growth.
Yeah,
wow,
I'm
EBITDA growth.
Yeah, look at that EBITDA growth.
Wow.
Okay, so this company is dramatically undervalued based on its future growth potential. And so when you ask me if it's risky, my answer is no. However, it's a small cap, it's highly volatile. I tell people all the time, man, this thing can go down 40% in a month. It just went up 70% in a week.
Yeah.
So, or not 70% a week. It went from $1.90 to $2.50 in a week. So, is it risky? Well, yeah, if you're a short-term trader. Is it risky from a long-term investor's point of view? And the answer is not really. I mean, they have a super competitive business model. They steal market share really easily. They capture customers really easily. They have sticky revenue. This company has never had a quarter where revenue went down, ever.
That's impressive.
That's crazy.
So, Coach, if you click on their financials and then switch from U.S. dollars to Canadian dollars, because this company reports in Canadian dollars. And if you leave it in U.S. dollars, the exchange rates kind of screw up the financials from quarter to quarter.
They skew it. Yeah.
Yeah, they skew it. So there'll be quarters where it gets skewed up and then skewed down. And then you look at their revenue, you see it, there it is on an annual basis. Look at how quickly their revenue has gone up. And then if you click on them on a quarterly basis, look at that revenue growth. Yeah. They've never had a quarter where revenue went down. So if you ask me if it's risky, I can't say no, but I want to say no, right? You know what I'm saying? They have super sticky revenue. Customers love the business. They have a huge amount of brand loyalty. They're kind of like Costco. People just love to go into Costco. Once you're a Costco customer, you're basically a Costco customer for life. And so this company sort of has that similar feel to it, where their financials.
And it doesn't matter the U.S. regulation, right? Or even Germany. It could just stay in Canada.
Yeah,
and it could be great.
Yeah, even without the ability to expand to new markets, they
still have a fair price for it.
So back to the PEGI method, if they have a EV to EBITDA of, I think it was about 8.2, and a price to cash flow of about 10, and they have an EBITDA growth of 50%, that means that they're pretty close to about their intrinsic value is pretty close to 500% above their current share price. So
Wow.
that means that their intrinsic value from a growth perspective is somewhere around $8 or $10 a share.
Yep.
So when you
why
ask
is it not?
why is it
Yeah.
not? So
It's getting there.
Well, yeah, it's getting there.
Yeah.
So the cannabis industry is super cyclical. So let's pull up a cannabis company that has been trading for several years. Let's pull up like Tilray or
I was gonna say,
Sundial
yeah.
or you just CGC, ACB, pull up Green Thumb Industries, pull up any other cannabis company you want. Something that's
Okay,
been
we can do,
trading for like
we can do like 7 of
You
them.
probably go to Pierce, so it would probably show you.
yeah, you could go to Piers. That's
Oh, that's
true.
true,
I didn't
yeah.
even think about that.
I was
Yeah.
just thinking, if that gets to $10, like by October, oh my god.
Oh yeah,
Yeah.
your calls are gonna print hard.
Oh my
Yeah.
god, yeah.
Because my thing is like I love the company. I'm just learning about it, and I just got in,
Yeah.
But I've listened to your thesis, and I love it.
Mhm.
But
Oh,
then
yeah.
at the back of my head, it's like it's 6% of my portfolio is in high tide, which is small cap. It's a weed stock, and that's generally people, say that's risky.
Yeah, well,
The cannabis industry.
yeah, people have gotten burned on cannabis so many times.
Yeah.
Because it's a cyclical industry, and they get talked into buying at the highs. And the secret is to wait until it falls down and trades in the gutter, and then buy at the lows.
You think Tilray will come back?
I think Tilray will do well like 5, 10, 20 years from now, but right
Okay.
now their financials are not super hot. So right now it's comparing it to a bunch of pharmaceutical peers like healthcare.
Mm-hmm.
So I guess you're going to have to build your own peers list. If you want to go up to the edit peers button, and we can build out a peers list of the top players in the industry.
Okay. Yeah, I definitely want to add Tilray to it.
Yeah, click on edit symbols.
Yeah. So it needed a 7th one, so it added that
Yeah.
one.
Get rid of all those that aren't high tide,
Okay.
so that we're only looking at cannabis companies. Yeah,
Okay.
leave Tilray on there, and get rid of CMER and ALIM and all that stuff.
Yeah, I kicked them off, so I'm looking at just High Tide and Tilray now.
So
then-
also let's add Sundial, let's add ACB, SNDL,
Oh, SNDL.
Uh,
Okay.
SNDL. Let's add GTBIF.
Okay.
Yeah, I'm watching on YouTube, and there's definitely some lag. So
Yeah, we can do 3 more.
let's add VRNOF.
Okay.
I'm trying to think if there's any other like cannabis giants that we should add.
Was there one called like Canopy Growth or something?
Yeah, that's CGC. Yeah,
CGC,
add
yeah.
CGC.
Yep.
And after canopy growth, I'd say we're going to get a pretty good picture of what I'm talking about with the industry is cyclical. So click on compare, and then we're going to look at like a 10-year chart. So in late 2018, Canada legalized for recreational, and the industry went on a massive rally, massive. And a lot of these companies had negative gross margins and were just burning money hand over fist, and so they diluted shareholders pretty heavily. You can see CGC used to trade at a much higher premium than it does
Yep.
right now.
Yep.
So the industry goes up, and then it falls down in the gutter. And then in early 2021, Biden got elected, and there was a lot of hype and a lot of hope that he was going to hurry up and change the laws like quickly, because the Democrats controlled the White House and the House and the Senate. And so there was another massive rally, huge rally. And then everything has fallen back down in the gutter again. And so if you talk to a cannabis investor when they bought the hype and the hope, they're down huge. They're down like, 70, 80, 90 plus percent, like if you look at if you look at just Sundial's down like 98%. That is a
Yep.
massive loss.
Yeah.
A massive loss. It's really hard for me to explain what losing 98% of your investment looks like.
Well, they're all down.
It's-
Even High Tide, 38% down in the last
well,
period here.
that's because when High Tide first started trading, it was at the tail end of the 2018 rally.
Mm-hmm.
So everything was super overvalued, and then it fell down in the gutter. And then in late 2020 and early 2021, everything rocketed back up again. And then it spent the last 3 years falling back down into the gutter. So look at all of these. Click on 1 year. Let's see what they've done over the last 1 year. More recently,
wow.
it has become more clear which companies are going to be the winners and which companies are not, right? And so some of these companies that have had huge rallies in the last couple of weeks, they're still down, right? Because they've diluted shareholders so hard that their stock price has just fallen like past the gutter, like it's down in the sewer drain. It's past the gutter.
Yeah.
And High Tide held up pretty well because they have a strong business model. They are not burning millions of dollars a quarter in cash. Some of their competitors are. And so it's a super cyclical industry. And to answer your question about people tell you it's risky, of course it's risky. Everything investing is risky, but it's especially risky if you buy things when they're overvalued. If you buy things during the top of a major rally, because often if it's in the news, if everyone's talking about it, it's overvalued, and that is true with every industry in the stock market. You want to look for damaged stocks, not damaged companies.
Well,
and so yeah.
Oh, I don't know about you guys, but I mean, I can accept that High Tide is risky, but if anybody tells me that Yieldmax is risky, I think I'm just going to ban people.
Yeah. Well, anytime you invest in an individual company,
you are idiot.
Yeah. Anytime you invest in an individual company, it's risky. You can't tell yourself it's not risky. I mean, but I tell myself that High Tide is not that risky because it has a super competitive business model.
Yep.
It has sticky revenue. It has strong brand loyalty. It captures market share. They have a low cost of expansion.
Mm-hmm.
I don't really think that the company is at any risk of failure. The share price could go down in the gutter again. That's a risk that could happen. But that's not to say that my long-term investment's going to do poorly. That just says that I might get a fantastic buying opportunity.
Yeah.
That's the way.
And they don't have debt, right? They have very low debt. Right?
They do have debt, but they don't have a lot of debt. So
they've been cutting it down, right?
Yes, they've been cutting it down. If you look at their long-term debt, they could pay off their long-term debt like tomorrow. They have more cash on hand than they do have long-term debt. But if you look at their, how do I explain this? So they have a huge amount of debt from leases. That's total debt. They also have some loans that they took out from a bank, and then they also have like short-term debt that's coming due. But they have plenty of cash on the books. Where if Coach, go to you see their long-term debt. Oh, you're looking at everything left to right.
Mm-hmm.
Look at them on a quarterly basis instead of annual.
Yep.
Because this stuff doesn't show up super hot on annual charts.
Mm-hmm.
And then let's take a look at their long-term debt, and let's take a look at their total debt. So
Canadian
total debt also
dollars too, right?
Yeah. Total debt also includes the cost of their leases, which they sign like 5-year leases.
Mm-hmm.
And so when you sign a new 5-year lease, all 5 years of that shows up in total debt. So they have a rather significant total debt number, but most of that's just the leases. Total debt. Sorry, I'm not used to looking at everything's right to left. I'm used to looking at everything left to right. So I'm instantly looking way off to the right, thinking, "Wow, why is that number so small?"
Oh yeah,
that's from 2021.
Yeah.
So their total debt is rather significant, but a huge portion of that isn't coming due for it's going to come slowly due over the next 5 years because it's leases. Their long-term debt, if you scroll, why is long-term debt just a bunch of dashes?
I guess
they definitely do have long-term debt.
Yeah, because if I go to annual, it showed one. At least there was one entry.
Yeah, I think the website's glitching. I don't really know what's wrong with this, but they definitely have some long-term debt, but they have significant cash on hand.
Yeah, because it shows here like.
Oh, you're at cash flow. You're in the cash flow. Go up, click on balance sheet.
Yeah.
Yeah, you're in the cash flow. All that's showing is how much cash they're spending on long-term debt.
Yeah.
Scroll up and click on balance sheet. That's what's confusing me here.
Yeah, I'm on the balance sheet now.
Okay.
I'll go quarterly.
Now take a look at their cash on hand. While we're up here at the top, total cash and short-term investments, $26.7 million.
Mm-hmm.
Yeah, still showing $26.7 million. And then go down and let's find long-term debt and let's find short-term debt. or
Okay.
long-term debt and total debt.
Okay.
So they do have some debt,
Yeah,
but their
here it
ability
is.
to pay that debt off is they can definitely pay their debt off.
Yeah.
There's no real risk of that at the moment.
Mm-hmm.
They have been paying their debt down. Long-term debt is they paid it down from 12.5 million to 0.1.
Yep.
That's pretty awesome.
Very
They basically
impressive.
got rid of
Yep.
yeah. They basically got rid of it. And then total debt, if you can find total debt, you might have to scroll down to find it.
Mm-hmm.
Because total debt includes their leases.
Yeah,
The
here it is.
28
Total debt right here. Yep.
Yeah. Well, and the leases, you can see 28.6 million of total debt.
Oh, I like how it
or
gives
of
like
leases.
a bar chart of it too.
Oh yeah.
Yeah,
You
yeah.
can see their debt changing over time. So they will never get rid of their total debt because their business model they're renting stores.
Mm-hmm.
And so that their total debt is never going to go to zero no matter what they do, unless they change their business model to owning stores, which I don't think they're going to do.
Yep.
Do you have another question or two, Dissector? I will happily talk about this company for like hours.
Yeah. So what do you think happens if the DEA reschedules? Do you think that's likely, number one? And then number two, you think that'll heavily influence the price because all of them move in tandem, right? All the cannabis
Yeah. So
stocks.
rescheduling alone probably won't be enough for high tide to move into the U.S. And that's a DEA decision whether or not they reschedule or what they reschedule it to. Unless, and there's a huge unless here, unless the Safe or Safer Banking Act is passed, which will allow cannabis companies to trade on the NASDAQ. And it'll also allow banks to finally give loans to cannabis companies. And the other way that it's possible is if the Department of Justice releases a letter or a statement saying that they don't care about all these like state legal cannabis companies and that it won't be a problem and that cannabis retailers can go ahead and operate in recreational markets without the federal government getting in the way. So that those are two options that would both let high tide like enter the U.S. market. See, right now they're a NASDAQ traded company, and the NASDAQ will not let U.S. based cannabis operators trade on the NASDAQ. So they could enter the U.S. today or tomorrow, but they'd have to delist back down to OTC, and the company refuses to do that. I think it would be unwise. I think they should just stay on the NASDAQ. And to answer your second question, or the second part of your question about rescheduling, the industry moves together. So in 2018, when Canada legalized, Canadian cannabis companies ripped up to the moon and went into this really strong euphoric rally. And then lagging behind them, but also experiencing a huge rally, all the U.S. companies started rallying as well. And then in 2021, when Biden was elected, all of the U.S. companies ripped up to the moon, like real quick, and then lagging behind them, but also experiencing a significant rally, the Canadian companies also ripped up to the moon. There was a delay, right? So when Canada had a major catalyst, the U.S. companies also rallied with them with a delay. And when the U.S. had a catalyst, or even not a catalyst, the hope for a catalyst, the Canadian companies also rallied really hard, but there was a delay there. So I expect for the same sort of situation to happen. Like history doesn't repeat itself, but it often rhymes.
Mm-hmm.
So if the U.S. reschedules, the U.S.-based companies and MSOS, the U.S. ETF, they're going to rip to the moon real hard, real fast. And then also joining them, but I expect a bit of a lag, right? I expect a bit of a delay. The Canadian cannabis companies are also going to rip to the moon. And another thing I like about High Tide is they trade on the NASDAQ. So there's a lot of brokers that won't let you buy OTC, or they'll charge you huge fees, like $30 or $50 commissions to buy OTC stocks. But they will let you buy NASDAQ listed companies without the fees. Or at all, and so the handful of companies that are on the NASDAQ that are Canadian, I think they're going to do really well, and this is one of them. There are a couple of others, but the money is going to flow into where it's allowed to flow, and a lot of brokers won't let people trade OTCs because they consider OTC to be especially risky. So even good companies like Green Thumb Industries, GTBIF, it's going to be limited in how high it can rally and how hard it can rally because a large number of retail investors are not allowed to trade in OTC, especially for foreigners. Like if you live in Europe and you want to buy into this North American cannabis bull run, most of foreigners are going to be limited to NASDAQ listed stocks. And there's very few of those in this industry. High Tide is one of them. So I expect High Tide to lag behind many of the US-based companies when the catalyst-driven rally hits. But I also expect it to experience a significant rally. I don't know where the top's going to be. Don't ask me. I don't have a price target. I just know that it's going to go parabolic. And after it goes parabolic, I'm going to sell a portion of my position, and then I'm going to let the rest of the shares ride for like a decade. Because remember, I'm in this because it's a good company, has a lot of growth potential. So
Yeah.
its intrinsic value should continue to climb. And like, so it's sort of like, I think I'm in a win-win situation, or actually I think I'm in a win/win more, right? If the catalyst never hits, this is still a good company. It still has a lot of growth potential. It's been improving its margins for like the last 5 quarters. And it has a lot of things I like about it. It has competitive advantage. The CEO's a shark. Their ability to expand into new markets cheaply, it's there. So the potential for them to actually make good on a law change in Germany or the US is real. And just for the most part, I'm in love with the fact that their business model steals customers and drives everyone else out of business, because they have a history of driving companies out of business. Fire and Flower used to be a big thing. They're bankrupt. There's another retailer named Trees in Canada. They used to exist. They're bankrupt. Things got so bad in Canada that Canopy Growth sold off all of their retail assets because they could not compete with High Tide in the retail end of things. They could still grow it. They can still do other things with cannabis, but they could not compete with the retail section. So they just sold all of the retail stores. They left. There's a whole bunch of ma and pa's that are going out of business in Canada. You want to like in general with investing, you want to look for durable competitive advantage, and this company has that. I like to phrase it like to people, it needs to be like watching Mike Tyson beat up a teenager. It needs to be just this totally unfair situation, and that's what you invest into. You buy 22-year-old Mike Tyson beating up a 15-year-old. That's what you should look for when it comes to picking individual companies. And that's sort of been my thesis for a long time now about companies in general. You want to look for companies that they're just doing something truly unfair that other companies either can't do or won't do or are too behind on the curve.
So I'm guessing you like High Tide more than MSOS?
So yeah, I'm running a 2-asset portfolio right now, and one of them is shares of High Tide, and the other one is MSOS calls.
You still have those, right?
Yeah, I still have those.
Yeah,
I'm refusing. They're either gonna die worthless, right, or they're gonna dramatically increase or decrease how long it takes me to get to retirement.
Mm-hmm.
So I have a thesis that the Biden administration they want extra votes, and there are a significant number of Americans that will swing their opinion on Joe Biden if he were to reschedule cannabis before the election.
Yep.
So I have a thesis that he is incentivized to put additional pressure on the DEA to hurry up and reschedule it. So in October of 2022, he asked both the DHHS and the DEA to look into the potential of rescheduling cannabis. In August 29th of 2023, the DHHS announced their findings, and they sent the results over to the DEA, and they said, hey, we think it should be Schedule 3. And all of us cannabis investors have been twiddling our thumbs waiting for the DEA to actually do something. Mm-hmm. And all we get is more like every couple of weeks we'll get information out of the DEA that they're still in their process of doing like a risk assessment on what rescheduling will do. So whenever they're done, they're going to announce that it's either taken off the controlled substance list altogether, which is unlikely, but it's possible, or it's moved to Schedule 3, which is quite likely because that's what the DHHS recommended based off of their research. And I think that as it seems like they've been dragging their feet, Biden is going to put additional pressure on them to stop dragging their feet and hurry it up.
Yep.
So I bought Leap's calls on MSOS that expire in January. and I keep buying calls, and I'm probably going to buy another one, like another leap, like next week. Buy another one in a couple weeks after that. I'm just dollar cost averaging into these leaps calls. The one that I bought first is actually one where I bought the bottom on. Earlier, you guys asked about buying the bottom on stuff. So I managed to buy a leaps call on December 22nd, and it was MSOS was trading at $6.41 that morning.
Yeah, that was
when
very impressive. You were like very close, if not at the bottom at that point.
Yeah, I missed the bottom by like 20 cents or something.
Yeah.
It was fantastic buy.
Mm.
But it was I didn't know that was the bottom. I thought it was a bottom, right?
Right.
And so then immediately after I bought just one call, right? I should have bought like 15 or 20 of these things.
Mm-hmm.
But immediately after I bought one call, and I told myself, I'm like, okay, now's the time to start dollar cost averaging into MSOS, because I think that there's a very high likelihood that this rescheduling thing is going to happen before the election. So I do believe in MSOS. I'm just not nearly as confident in the long-term potential as I am in high tide.
What do you think about? So a commenter pointed out this MSOX, which is a 2x MSOS.
Yes.
Yeah.
So I currently own a bunch of leaps on MSOS, and it shares a high tide.
Mm-hmm.
And the day rescheduling is announced, I'm going to take the very last of my cash in my brokerage account, because I keep a cushion there for like emergency fund reasons and stuff.
Mm-hmm.
And I'm going to buy calls on MSOX, which is the leveraged version of MSOS.
When
it does have an options market. It'll be the day after the DEA makes the announcement.
Okay.
Yeah, that's what I'm going to buy calls on this.
Yeah.
Because I want to
be good premiums.
Yeah, I will pay a significant premium, because it'll be the day after the news event.
Why don't you just get it now?
Because it's a leveraged ETF.
Yeah.
And I'll lose money on both theta
Oh yeah.
and the leverage decay.
Mm-hmm. I see.
But you said high tide needs more than just rescheduling to make it to the U.S., right?
Yeah.
You think so?
Yeah.
So what else would have happened?
So the Safe Banking Act would allow it to stay on the NASDAQ. Sorry, I'm losing my voice. The Safe Banking Act would allow it to stay on the NASDAQ and expand into the U.S.
Mm-hmm.
The other thing that would let it happen, there's a second door, and it's the potential for the Department of Justice coming out with some sort of a notice saying that we are not going to mess with recreational operations in these states that have already allowed recreational. So either of those paths open the door. So either some sort of a thing by like an announcement by Merrick Garland that the DOJ, or if Congress were to pass the Safe Banking Act, that either of those paths would open the door for high tide. Or the third path, which is unlikely, is that the DEA takes it off of the controlled substance list altogether, and it just goes to like, Schedule 6, which means no scheduling. That would also open the door for high tide to expand. And I think all of these three things are very likely to happen eventually, but I think what's going to happen before the election is probably just Schedule 3, which is not going to open the door for high tide, but it is going to cause a major industry-wide rally, because this whole industry has a history of these huge euphoric rallies, and it's very difficult for me to say where the rally is going to take these companies. Every company that we had up on the peers list earlier, they're all going to rally super hard.
Mm-hmm.
But I don't know where the top is.
Yep.
Yeah, I think I'm going to add more to high tide. It looks great.
Yeah, it's my highest conviction investment that I've ever made, ever. And once you get into a good company, it's really hard to sell. It's very hard to sell. It's the type of thing where, you put all this research in, and you want to be correct, and you find a long-term compounder, or at least you find a company that has the potential to become a long-term compounder, and you just want to stay in it for a long time. As long as the CEO is in good health and making good decisions, and the business model is strong, they should continue to compound your wealth for you over time. So that's why earlier I mentioned I had a 3 to 10 year outlook on investing. When I choose an investment, It's possible I'm only in it for a month, it's possible I'm only in it for 6 months, but when I make the buying decision, I have a 3 to 10 year outlook on would I be happy holding this company over the next, 10 years. And if the answer is not yes, then I go find something else to buy.
So do you have any other high conviction stocks right now?
Yeah. So I have high conviction business models, but I haven't checked recently if any of them are under or overvalued. So I'm not sure if you should just go buy them right away. Otis, they're an elevator and escalator company. They've been in operation for 170 years now. They were spun off of Raytheon in 2018. They have a strong competitive moat. Yeah, go ahead and pull up Otis.
Yep.
Since they were spun off, the share price has more than doubled. So they have, go ahead and pull up like a 5-year or 10-year or something like that. Yeah, max, sure.
Yeah.
So at some point in the past, Raytheon bought this legacy company. It's been in existence since the Civil War. This has been in operation for 170 years now. They bought them at some point in the past. They spun them off in 2018. They have a strong competitive moat. They have high cash flow. They buy back shares. They have a small dividend, but they're increasing their dividend over time. So this is one of the companies I look into. I'm thinking about buying for my retirement because that dividend yield, they might only be paying like 1.4% right now or 1.3% or whatever, but in another 20 years they'll be paying like 5% of what I paid today, right?
Yeah, Coach, what's the dividend growth?
Let's see.
Look at that.
Yeah.
Go click on the dividends tab and it'll show us what the growth has been recently.
Oh, it's got an A for 1 year dividend growth rate.
Yeah.
Yep. It's not Yieldmax, but it's growing.
It's growing. It's growing.
Needs another 49%.
Yeah.
Yeah, right.
Yeah.
It could eventually produce extremely attractive yields. If I'm going to hold this thing for 30 or 40 years, and so I know I just said that I'm willing to hold stuff for a decade. Well, when I'm looking into retirement stocks, I'm willing to hold them for multiple decades. Companies that I think are going to do really well for basically the whole rest of my life. Yeah. Orion in the comments, look for yield on cost. Yeah. This company is very likely to have attractive yield on cost when I'm 90, in another 50 years.
Yeah. You probably scroll down to that, Coach.
Oh, yeah.
It's going to be under yield or growth, I think.
Let's see. We got the chart here, growth history.
But you haven't bought any, Blake?
No,
You're just
I haven't.
You're just looking for
I
valuation.
haven't. Well, and I've been looking at this company for about 2 years now. And the real problem is that I'm only 40, and I want to retire when I'm like 50. So at some point in the next decade, I'm going to start buying up these companies. I don't really know when. I just know I started researching retirement stocks about 1.5 years ago, because I know that eventually I need to transition from like a small cap, micro cap growth investor to a long-term dividend yield investor. And I sort of wish I had started this process when I was like 20 years old.
Oh, here it is, yield on cost. Yep.
So are you planning on using the 4% rule or dividends or like a mix of both?
Probably a mix of both. What I'm really looking for with these companies is I view the yield growth as an output. And one of the things that drives this output that makes it possible is their buyback rate. So, Coach, go up to their financials and click on balance sheet. And let's take a look at this company's buyback rate. And we're going to scroll down and look for total common shares outstanding. So when they buy back shares, every time they buy back shares, they make it easier and easier for them to increase the dividend. And in addition to that, the earnings per share metric goes up. Wall Street loves earnings per share going up. So if you can look, let's see, just 2 years ago, they had 426 million shares outstanding. Now they have 406. Is that what that says? Can you hit Control Plus once and make all those numbers just a little bit bigger?
Yep.
They're a little blurry here while I'm watching on YouTube.
Yeah, here we go.
So you can see this company basically buys back a small amount of shares every quarter.
Mm-hmm.
And so I was talking earlier about Altria Group. They basically do the same thing. They buy back a small amount of shares every quarter, and they increase their dividend like once a year. And if you let this play out for you, like thought experiment, what is their share count going to be in 20 years or 30 years? And then how easy is it going to be for them to continually pay higher and higher dividends? As long as they can maintain their strong cash flow, right? So Coach, scroll up and click on profitability, and we'll take a look at their profitability metrics. As long as they can maintain their profitability metrics, they should be able to continue this eternal process of buying back shares and increasing dividend growth. And so I view the dividend yield as an output, and the input for this output is the buyback rate, and the input for the buyback rate is their cash flow. So click on profitability and then scroll down, and we're looking for free cash flow yield or free cash flow, levered free cash flow margin. There it is.
Yeah.
10.84%. So this company, based on its revenue, has been producing 10.8% cash flow. So that's a pretty good metric. That's pretty strong. It's certainly not the most profitable company in the world, but this company has a strong competitive advantage. They do not need to advertise. If you're going to build a skyscraper, you only have so many elevator companies to choose from, right?
Yeah.
So this is sort of my thinking on this. So another one to look into, besides Otis here, I'm also looking into Tractor Supply Company.
Yeah,
So
that's a good one.
Coach, type in TSCO.
Yep. Doesn't Debt Slave talk about that one too?
I'm not sure. I
Yeah.
I have not had a conversation with Debt Slave about Tractor Supply Company, but
he mentioned it
now
once.
now that you mention it, I should have a conversation with him
Yeah.
about TSCO.
Yep.
So go ahead and click on the summary first. Let's look at the share price right off the bat.
Mm-hmm. Yeah, 250, 249.
Mm-hmm.
17% up year to date.
Yeah, look at them on a 10-year chart or a max chart.
Oh, their max is like 2019. Let's see. Let me zoom back out.
Yeah, so this is another company that meets my checks my boxes. It is drowning in cash and buying back shares.
Mm-hmm.
And I don't really care if their revenue stays flat. I mean, I don't know. Maybe the revenue's growing. Maybe it's staying flat. I don't really care. What I care about is that the customers that are near each individual store continue to use their products and services, right?
Mm-hmm.
So it is possible for a company to have flat revenue as long as it's nice and stable, if they're highly profitable, and if they don't have advertising expenses, they don't have R&D expenses. That's another reason I avoid tech, is they typically have really high R&D costs to try to stay relevant, to stay competitive.
CJ Navage says they're burning through a lot of cash to keep customers.
TSCO is?
Yeah.
Okay. To
But
keep
still,
customers. Well, look at their levered free cash flow margin. Right, or sorry, levered free cash flow right there. You see that? You see that column?
Yeah.
So it looks like they have cyclical cash flow. Right, so some quarters they make a lot, some quarters they lose a lot, but the net result should be fairly attractive because they're buying back shares. So maybe since CK Minaj there pointed out the burning cash thing, scroll up and click on the profitability tab, and let's take a look at what their profitability has been.
Yep.
Yeah, this is another company that I have not bought any of, but I'm considering it. It's on my short list of things to look for because I love companies that are competitive. They have to have strong margins, and they don't need to spend money on R&D or advertising.
What do you say to someone, like, I feel like a lot of people stay away from this because of the price, but they'll go for, like, a Yieldmax fund or something because it's, say, like $20. But return doesn't matter. Like, I mean, you can buy fractional shares now.
Well, price is basically irrelevant.
Yeah.
The instead of looking at price in a vacuum, let's do a valuation on this thing.
Yeah.
So click on valuation. I'm going to use the Peggy method here again.
Yep.
And then let's look at EV to EBITDA and price to cash flow. We're going to basically ignore PE because PE is an accounting metric.
Yeah. So
A
EV.
huge number of people use PE, and it's not a good idea to use PE.
Mhm.
So EV to EBITDA, we're looking at the forward number, so 16.52, and price to cash flow. There is no listed price to cash flow for forward.
Mhm.
They do have a trailing 12 months price to cash flow of 20.43. So let's take a look at that forward EV to EBITDA of 16.52, and let's compare that to their growth potential for the EBITDA growth.
Okay.
So scroll up and go to profitability, or sorry, go to growth. You're at valuation. Go to growth, and we're going to look at the. Since we're looking at EV to EBITDA, it makes the most sense to look at either earnings per share growth or EBITDA growth. So their forward EBITDA growth is only 5.04%. It looks like this company is currently overvalued.
Mhm.
Do they have a listed? They do have EPS forward long-term CAGR of 6.21, or does that say 6.27? Either way, it looks like the company
Yeah.
is currently overvalued, and I would not buy it at today's price.
Mhm.
The actual share price is basically the last thing I look at when I consider an investment. The first thing I look at is the business model. The second thing I look at are the financials. Often, without even knowing what the business model is, you can look at the financials of a company and decide, this is not very attractive. Boy, their levered free cash flow growth at 122.8, that kind of jumps out at me.
Yeah.
That's pretty significant.
Yeah. And 1,000% difference to sector over here.
Oh yeah.
Yeah.
They're a lot more profitable than their competition.
Mhm.
I think the last time I looked at them, their growth page was more attractive than it is right now.
Yep.
So this is not a company I would buy today,
Mhm.
but this is still on my list of companies to watch. Let's see, another company I'm thinking about for my retirement, Thermo Fisher Scientific, TMO.
Yeah. 579.46.
Oh yeah, so this company makes medical devices.
Mhm.
They make incubators. They make all sorts of stuff that the pharmaceutical industry needs. Go ahead and click on the max. You'll
Wow.
see
3,258%. That goes
Yeah.
back to the 90s, though. Yeah.
Well, this company has been a fantastic investment for long-term shareholders.
Mhm.
And so they sort of have the Microsoft business model where when somebody comes out with a hot new thing and it looks like they're going to become a competitor,
Mhm.
this company will just buy them out, just like Microsoft does. So this company is sort of an umbrella company that controls dozens and dozens of smaller companies. And every time a new competitor emerges with some hot new technology or their ability to manufacture a brand new device, this company will just buy them and incorporate them into the business. So they have a durable competitive advantage because they're willing to buy into additional moat, right? They have an already moat established, and they're going to make sure that their moat is not eroded by buying the companies that would attack their moat. So similar to Microsoft, as long as they keep this up, they're not going to die anytime soon. Let's see. Another one that I'm thinking about buying for my retirement. Sorry, I'm going to speed it up because I'm getting tired and my
Yeah.
voice is losing.
I'm going to have to go
Honey-
in a minute, too. Yeah.
Yeah, Honeywell, HON.
HON.
Yeah.
Yeah, they've been around for a while. Yeah. It's a good,
Yep.
solid one. It's a buy on all three. Yep.
Yep.
Over here.
Yep. I think I might have contributed to those buy ratings.
Oh, yeah?
Because I'm pretty sure I wrote an article, a bullish article about Honeywell a few months ago.
Yep.
So this company, they do automation and they do like instrumentation. That's how I was first introduced to Honeywell in maybe it was 2003 or 2004. When I was going to school for mechanical engineering, they had us learn a lot of stuff about instrumentation, and like if you're going to automate a factory or automate like a power plant, you need a bunch of sensors and controls. And this company makes those. So They also are into quantum computing. For anybody who is interested in quantum computing, they're busy developing their own quantum computing system.
Interesting.
Yeah. So this company stays relevant by developing new technology. So previously, I know I mentioned I try to avoid companies with significant R&D costs. This is one of the few companies that I'm willing to buy into, even though they have significant R&D costs. Because part of what they do is they're a tech company, but they're not like internet tech. They're in like applied technology. So this is another one that I'm looking at. I guarantee that yield of 2.19% should go up over time. I can't guarantee that it is, but I guarantee that it should. Right.
Yeah.
So these are companies I'm looking for. If the recipe is right, you can buy companies with really attractive yield on cost. And the example I always give people, what's their dividend growth?
Let's see.
Their
1 year, 5.04%.
Okay.
Yeah.
Okay. So that is not as attractive as I would like. Obviously I want more like 20 to 25% dividend growth per year. But hey, this company is extremely well diversified. They have multiple segments.
Yep.
The example that I always give people is during the 1987 crash, Warren Buffett stepped in and bought a bunch of Coca-Cola. And at the time that he bought it, the yield on Coca-Cola was actually still pretty unattractive compared to the share price that he bought it at.
Yep.
But if you look at his yield on cost, meaning today's yield versus what he bought the shares for 35 years ago, it's roughly 50%. So, if you want those Yieldmax gains where Yieldmax is paying you 50%, you have to just buy these good, solid companies during a crash. That's the best time to buy them. And you have to wait 35 years.
Yeah.
Right.
Or
and
take your own dividend too, like with a growth stock.
Yeah. Well, and you can always reinvest that dividend. But if you're extremely patient and you take that money that they pay you and you go, diversify your portfolio, you buy other good companies, whatever. If you're Warren Buffett, you use it to make insurance claims. Like you build in the insurance world, there's this term called float.
Yep.
And they're not talking about the number of shares. They're talking about the amount of cash that they have available to pay out insurance claims. So if you're Warren Buffett, you keep a huge amount of cash on hand so that you can have a larger float and that you can issue more insurance contracts. So, someone is commenting, Honeywell is solid. That's one of the reasons why I really like Honeywell. It's not that I believe that their growth potential is large. It's that I believe that this company has a very low chance of failure.
Yep.
Similar to Microsoft. Like, I don't think Microsoft is necessarily going to 10x its revenue over the next, 50 years. I mean, they could very easily do that.
Right.
But what I do know about Microsoft is that it has an ultra low probability of failure.
Yep.
So this is another company, ultra low probability of failure. And so these are the types of companies I'm looking at from my retirement that I want to live off the dividends. And I also expect share price appreciation. And I can sell shares. I can just trim, 4% every year as I get older and older. And these companies should compound for me, over really long time frames. They will build my wealth even in my retirement.
Do you like Apple at the current price that it's at?
I do like Apple, but I'm not sure if the current price is what to do. So let's take a look at the valuation. Let's have this be the last company we look at before I go to bed, because I need to go to bed soon.
Yeah, I gotta sign off too. Yep.
So click on valuation, and then let's look at their EV to EBITDA and their price to cash flow.
Yep. Okay, EV
So,
to EBITDA here. Yep.
Yeah, 19.32 EV to EBITDA, and the price to cash flow is 22.32. So let's go ahead and look at their growth potential. And these growth potential numbers, it's just the conglomerated aggregation of a bunch of different analysts, right? When you look at these growth potential numbers, these are not set in stone, right? You're looking into the future, you're getting a bunch of different opinions, and you conglomerate them into a single number. It's an average.
Yeah.
So their EBITDA growth is only 2.6%, okay? And their cash flow growth, let's see, let's look at levered free cash flow growth is only 1.41%. I would say that I do not like Apple at this price.
Yeah.
But if you're already in Apple, I don't think it's a reason to sell just
Right.
because it's overvalued, you know.
Right.
So I would not buy Apple right now.
Hmm.
I look for things that have a PEGI ratio below 1 and preferably like below 5, or sorry, below 0.5, like High Tide has a PEGI of about 0.2 or 0.25 right in there. It's real cheap
Yep.
based on its future growth potential. Often when you come across these really solid, mature companies, everybody knows they're a good company. And so the market as a whole, millions of retail investors, they've already driven the price up really high. And it's very hard to justify buying a good company except during a black swan event.
Yep.
Like Warren Buffett buying
Yeah.
Coca-Cola in 1987. You know, that is the time to buy the Microsofts, the Googles, the Apples is during a black swan. If you buy at any other time, you run the risk of opening yourself up to lackluster returns. And this is also what's forced me to go into small caps and micro caps, because many of those companies are undercovered by analysts, and the market has yet to realize they're a good company. You just have to do the research ahead of time. But unfortunately, they don't tend to pay dividends. So
Darn.
yeah, darn, right? So as I
Yes.
approach retirement, I'm gonna have to shift my thinking on what I'm willing to buy if I want any dividends at all.
Right.
I could
So I have a
just yeah.
Go ahead.
No, go ahead. Ask your question.
I was gonna say, like, how would you feel? Like, let's say me, I have 40-year, 30-year time horizon. How would you say about me saying just like, I don't really care about the value. I'm just gonna get Otis or one of the other stocks you just mentioned, just to get that compounding going for like these super reliable companies you're mentioning. Or do you think the valuation matters way too much?
I have conflicting beliefs about that. I definitely think that if you have a really long time frame outlook, today's valuation kind of doesn't matter. However, if you want to have attractive total returns every year, from this year forever till you're like 90 or something, today's valuation does matter. So when you buy one of these rock solid companies when they are currently overvalued, what's going to happen is the current share price is above the intrinsic value of the company, and so you might have to sit there and be willing to wait for 2, 3, 5, 7 years or something for the intrinsic value to push up above whatever you bought for today. And a lot of people are willing to buy amazing companies even though they're overvalued, because they know that all they have to do is be patient and wait. And eventually, the intrinsic value of the company will push above today's share price. And then after that happens, you can expect attractive compounding to happen for you.
Mm-hmm.
And so, for example, like a Microsoft, Microsoft typically trades at a rather high valuation. If you buy today, there's really no guarantee that it's going to compound for you this year or next year or even the third year. But you can be pretty confident that they're going to compound for you eventually, right? Because it's a solid company. Same with, Otis and Honeywell and all the others I mentioned. If you buy at a higher valuation, you might have to suffer through a short period of a few years where it basically just trades sideways.
Yep.
But eventually, back to the efficient market business, over short time frames, markets are highly inefficient, and over longer time frames, they're highly efficient. So if you have a really long time frame outlook, if it truly is a solid business model, it will compound for you. And if it really does produce significant cash flow, because it's a machine, these companies are machines. If it really does produce significant cash flow, it should compound for you sooner rather than later, especially if they are spending their cash flow efficiently. Like if they have really low capex, and they have low advertising, and they have low R&D costs. What else are they going to do with their cash flow? Right? They have to do something productive with it. And you also, I like to look for companies, and this is why, because I'm trying to avoid that 3 to 5 year period with nothing to do, where the share price could just trade sideways. I look for companies that have nothing better to do with their money but buy back shares and raise the dividend, because raising the dividend and buying back shares produces attractive earnings per share increases, and Wall Street absolutely loves when your earnings per share goes up. They kind of don't care how you achieved it. So I guess the last company I want to point out is Dillard's. I brought them up earlier.
Oh, that's right. Yeah.
Ticker DDS. If you pull up what their share price has done over the last like 5 or 10 years.
Yeah.
This company has flat revenue. There's really nothing magical about their business model.
Oh, wow.
Like Coach said, he thought they were dying.
I did, yeah, because so many malls have lost them. Like
Yeah.
they've just closed. Yeah.
Right. Look at what the share price has done.
I see.
That's incredible.
Wow.
Right. And
Yeah.
the whole reason this is possible with flat revenue and not even a particularly competitive moat is because they don't really have anything better to do with their money but buy back shares.
So just think about this. One of their competitors was JCPenney, who I think they filed for bankruptcy.
Yeah.
Yeah. It's incredible.
So if you find companies that they don't have anything to do but buy back shares and increase their dividend growth, because spending money on advertising would be a waste of their time.
Mm-hmm.
And their business model has low R&D expenses. Those are things that I like to look for when I look at fully mature companies, because they could easily be a Dillard's. Like, click on the 5-year chart or the 10-year chart. That's what you want in a mature company. You want them to realize opening new stores is a waste of my time. I might as well just buy back shares.
Mm-hmm.
And Wall Street absolutely loves it when you buy back shares. Look at what the share price did.
Yep.
Yeah. And this is because their earnings per share keeps going up. So if you click on financials, I think if you look at the earnings statement, somewhere in one of the 3 financials. So click on financials, and then I think earnings statements, income statement. Sorry, that's what I'm trying to say.
Yeah.
Income statement. If you scroll to the very bottom, you might find earnings per share listed.
Yeah.
I think it's in the income statement. Yeah, I think EPS per share is listed in the income statement, but it might be in one of the other ones. Keep scrolling. Oh, basic EPS. Yeah, there you go.
Yep.
So their EPS previously at the beginning of this, let's see, this is quarterly? Yeah, this is quarterly. 2 years ago their EPS was $9.81 and it's currently $15.46.
Yep.
And that is what buying back shares does for you. So I'm going to go ahead and lay down and go to bed. So
yeah, I'm going to end it.
Can I add something real quick?
Yeah.
Go ahead. Yeah, you've been on a while. Yeah.
Yeah, I'm just adding it to your thesis about buying back share. I think the last 5 years, the reason Apple has gone up because they didn't know what to do with their money and they bought all these shares back, right?
Yeah.
Mm-hmm.
Because Apple had not done anything innovative for the last 5 years. They just wait for somebody to do something, either buy that company or copy them, like the AirPod and so forth.
Oh yeah.
This is no longer the Steve Jobs company.
True.
Tim Cook is just running it like almost like a dying business in a sense, right?
Yeah.
I mean, nothing innovative have come out of them in the last 5-10 years.
Yeah, that's a good point.
It's
Yep.
incredible. Yeah, so I wouldn't buy them,
Yep.
but a Black Swan event, I would buy them, but not at the
Mhm.
first stage, in my opinion.
Yeah.
That's all.
Yeah. Okay. Yeah. Well,
All
good
right.
show.
Thanks for
everyone.
the questions and conversation, Blake and Coach.
Yeah.
Everyone.
Yeah.
That was good.
Yeah. Thanks everyone for.
Yeah, I
for
definitely have
joining.
some more questions for you, Blake. So we'll talk again.
For sure. Another time.
Yeah.
All right, guys.
All right. Have a good night.
All right, you too.
Yep. Have a good night, everybody.
All right. Thanks everyone for tuning in. Like, comment, and subscribe, and join Discord if you haven't already. And we will see you all in the next one. Take care. Bye.